delighted to host you here in Mumbai, the commercial and financial heartbeat of India, where distribution leaders, capital market institutions, product innovators, and advisors come together to shape the next phase of wealth creation. Mumbai isn't just our host city. As all you know, it's the financial capital of the country, and the city contributes over 6% of India's GDP and drives nearly 70% of capital market transactions. It's also home to institutions like the RBI, BSE, and the NSE, where capital is allocated and market trends often take shape first. We also meet at a particularly interesting moment for India's markets. SIP flows are providing structural stability, retail participation is expanding rapidly, and household savings are steadily shifting towards financial assets. At the same time, we are seeing tighter regulatory frameworks around transparency and suitability are raising the bar for distribution. Add to that, we have the global tensions upon us around the critical energy routes like the Strait of Hormuz, which are influencing oil prices and market volatility. And it's clear why conversations around asset allocation, diversification, and investor confidence matter more than ever. So against this backdrop, FiDEX 2026 is more than an industry gathering. It's a platform to explore how India's distribution ecosystem will evolve, how access to advice will deepen, and how wealth will be created, protected, and compounded in the years ahead. With that, let's begin the day one of Moneycontrol's FiDEX 2026. Let's give a huge round of applause. All right, as India's financial markets expands, inclusion is becoming the next frontier. Millions of first-time investors are entering the system, but access alone is not enough. Education, credible advice, and strong regulatory frameworks are essential to ensure informed participation. With regulatory reforms continuing to reshape the ecosystem, advisory and distribution entrepreneurship is emerging as a powerful engine for financial inclusion. The question now is, how do we scale trust, literacy, and responsible advice across a rapidly expanding investor base? To share his perspective on the evolving landscape, please welcome with a warm round of applause, Kamlesh Varshne, whole-time member of SEBI.
Hello, yes. Good morning, everyone. Thank you very much for that very nice introduction. It's very nice to be here amongst you all for this expo, which has been organized by Moneycontrol FiDEX. I think it's a very good platform where we all can see what progress we are making and what are the challenges ahead and how we can fill those gaps which are there. Because all our aim is one common aim, how we can take India to Viksit Bharat in 2047. Now, when we say that that is the ultimate goal, that goal can be split into smaller goals for each one of us. For example, we are in the financial sector, so how we can keep sustainable growth in our financial sector, while Indian economy is growing at a sustainable rate of more than 7%, which is highest in the world, how our financial market can grow at the same pace to provide that kind of stimulus to the economy and also make use of the high growth rate. So if we look at the number, we will feel very happy about it. Particularly when we compare it from the past, we can say that we have 14 crore unique investors. And in last 6 years, they have grown by 3 times, which is a very good growth rate. Similarly, if we look at mutual fund asset under management, we will see 81 lakh crore, which once again has increased 6 times in last 10 years and 3 times in last 5 years. Excellent progress. Lot of retail investors are coming in through SIP or through direct investment, which is really giving a flip to mutual fund industry. But if that is one way of looking at that we are really progressing very well. But what are the opportunities or gaps? If we see from the other side, this 14 crore unique investors is only 10% of our population. So the survey was done by SEBI in 2025. Towards the end of 2025, 9,000 people were surveyed, and that was the outcome. What is the reason that only 10% people are investing in security market? We found out that the penetration level is very low because there is risk aversion. There is a kind of a resistance to enter capital market. Though 63% people are aware about capital market, but only 9.5 or 10% actually enter capital market. And it is not that this low number is because people in rural area or farmers are not entering. Even in city level, this number is very less. So state-wise comparison, the highest is Delhi, 22%. Maharashtra comes third or fourth at 17%. You know, we call Maharashtra as having Mumbai financial capital, other cities who have progressed very well, but that number is very less. And what is the reason? As I told you, risk aversion is the reason, but I also think another reason is trust. The kind of news that we are getting in the market, people are losing money through fake app, fake payment leave, wrong advices, influencers. What is that which is because of that people are little bit reluctant to enter capital market? Imagine if this 63% people who are aware of capital market, that trust is built with these people directly connecting with them, how much investment we can get, which can be used for capital formation, which will again give flip to our Indian economy. So this is what our aim should be, that how should we will trust and transparency in the system, so that most of these 63% people who are aware actually start investing in capital market. So there, from our side, we are taking a lot of steps. SEBI, the regulator, we have initiated many steps using technology. For example, if I speak technically, there are a number of steps like pledging, repledging, directly upstreaming of fund, direct payout of securities. These have been done to ensure that there is no misuse of client fund or client security by the brokers. There was one big case which happened some years back where that client security was misused by the broker and he pledged that to the bank and got loan and then went bust. Now, who should get those securities? Whether client should get it or that bank should get it, right? That case is still going on. SAT has given one decision. We have challenged that in court, so it is pending in Supreme Court. The issue is whosoever gets, there is a loss to somebody else. So we changed the system that client security, client fund does not get mixed with brokers fund, broker security, and that is system of pledging and repledging is using technology is made safe. The security will remain in client's account and that will get pledged and repledged, and that cannot be pledged with the bank. So that latest RBI circular is also aligned with that particular concept. So that is one way using technology how we have ensured that that risk of misuse of client fund and security is taken care of. There are other ways what we have done is, particularly I would like to touch upon the fraud which is happening. You know, every day we hear how people lose money to fake app and fake payment links. You know, everybody will say that today this big person is appearing, his impersonating videos are appearing, circulating in social media, giving some advice, and then, you know, some people create fake payment links, fake WhatsApp groups. They add you there and you make payment to them, and they will show you some fake screen which will show that your investment is growing much faster than what market is growing, and you think it is right, you put more money, and when you try to take that money out, they will disappear, right? This we have seen in many cases, and it is not uneducated people who are falling prey to this kind of a scam. All of people like you, educated people, doctors, engineers, scientists, they all are falling prey to it because they believe what is shown to them. You know, that is how the social media is of today. We start believing what is shown to us again and again. So what have we done? In SEBI, we have come out with a very good instrument, SEBI Check. Now this SEBI Check can be accessed in two ways. One is you can download Sarthi 2.0 app, which has this facility of SEBI Check, or you can directly go to SEBI Check without the app. There is a link on the website of SEBI, sebi.gov.in. Now gov.in a very safe domain name. So if you go to sebi.gov.in, there is a QR code through which you can go to SEBI Check. Now SEBI Check is very, very useful because you can use that SEBI Check to scan any QR code. And that QR code will tell you whether it is a QR code of a capital market intermediary. So it will say, yes, you can make the payment, or it will say, no, you should not make the payment because this QR code does not belong to any capital market intermediary. And we actually go to colleges, universities, where all students, hundreds of students are sitting there, and we demonstrate them. That take out the QR code of your chai wala or samosa wala, it will show, no, you can't make payment to him. I mean, you can make payment to him if you are making payment for tea or samosa, that is fine. But if somebody is giving that QR code to say that this QR code belongs to, let's say, some big broker, Zerodha, Motilal or Angel or whatever, Grow, that is fake. That it will show it is fake. But if it is actually of these brokers, it will say, yes, you can make payment. So that kind of instrumentality we have developed. You can also, if you are not making payment through QR code, but you are making payment through internet, the internet banking, you can actually enter the account number and IFSC code. And it will tell you, that SEBI Check tool will tell you that this account number is genuine or non-genuine. So before making large payments, I mean, it can happen that, your SIP is 1,000 rupees per month and whatever, is whether you want to check. Yes, you should check, but whenever you are making a large amount of payment, you must check through SEBI Check. This is very important. That is one step. Another step that we have done is we have spoken with Google. So if you have Android phone, you go to Google app. In that Google app, if you want to download any app of capital market intermediaries, then it will show that it is verified app or not. If it has a verified tick, there will be three things over there, that how many people have downloaded and this thing, and then third one is verified. If that verified tick is there, that means this app belongs to a genuine capital market intermediary. If that verified link is not there, it means it is a fake app. Just a clarification, this is only for capital market apps, not for other apps. So other apps may be genuine and will not have verified tick. This we have done, SEBI has done with Google. It was not easy for asking them to do it. This is first time they have done in the world. They have not done it anywhere else. And now they are saying that we will roll it out to other countries. But we managed to convince them. Why? Because we told them that technology and AI have two sides. There are category of people who are good users of technology, good users of AI, while on the other side, they are manipulators. Now, if we want to fight those manipulators, the bad users of AI and technology, then these good people have to come together. And that is how we convince Google that we need to come together. Apple has still not come on board. So if you have an iPhone, though probably Apple Play Store, you cannot use this verified. But we are in discussion with them. It is in their interest, it is in the interest of everybody that they should also come out with verified tick on genuine apps. And going forward, why only capital market apps? Probably they can extend it to all other regulators also, insurance regulators, banking regulators, because they have to depend on us to tell us whether it is a verified app or not, which we tell them, and then they put that mark verified. So these are the kind of developments which are taking place, which are unique, as I said, nowhere in the world. What I told you earlier, like pledging, repledging, upstreaming, direct payout is also unique in the world. We were the first country to implement T+1 settlement. USA did it after us. So once again, these things show that how proactive SEBI has been in developing technology, which is to build trust and transparency. Another thing, steps that we have taken recently, which is on trial stage, is PARVA, which is verification. Right now, we don't allow IA and RA algo providers to advertise their performance. Because if they advertise their performance, who is going to verify that it is genuine or not? Right? Now, the result of that is that unregistered influencers are happily advertising performance, and these people are suffering. So they used to come to us that, I mean, those unregistered people are, doing the wrong things, and we are prevented to even showcase our own performance. How do we win clients if we don't showcase our performance? So we have come out with this instrument. NSE and CARE have built this instrument. It is already under trial stage. More than 25 people are on board, and our trial stage will get completed in April. And by May or June, it will actually be rolled out in a proper way. So this is a platform where if I want to advertise my performance, I will enroll on that platform, and whatever advice I am giving, if I am an advisor, or if I am an algo provider, my algo result will get tracked on a real-time basis. So I cannot pick and choose. It will get tracked on real-time basis, and at the end of 3 months or 6 months, whatever period I have chosen, this PARVA platform will, kind of in a given format, will publish my performance. And that performance I can advertise. Now, this is again something which has not happened anywhere in the world. First time it is happening in India. And this will again allow these people to advertise their performance, which is correct, verified. All these steps I have said are for developing trust and transparency. You people also need to focus on these two pillars, important pillars, trust and transparency, because that is what I go back to my initial numbers. If you develop these trust and transparency, there are many people, many citizens of India who are willing to join this ecosystem of capital market. And if that happens, it is good for the country, good for the capital market, and good for all of you who will derive your economic benefit, economic remuneration from the new generation which is entering capital market. Challenges are there, but opportunities are also there. It all depends on how do we make use of those opportunities, how do we catch those opportunities. They may be difficult chances, but you have to catch them. Just like what Akshar Patel did yesterday, the 2 catches that he took were difficult catches, but he caught them and India won the match. So all of you, please build those trust and transparency and catch whatever opportunity is given to you so that we all win together. Thank you very much.
Thank you, Mr. Varshney, and requesting you to continue to be on stage. And I would now request Mahalakshmi to also join him on the stage.
Am I audible? Yeah. Thank you so much. It was a beautiful opening address, and one of the first points you made was this, difference between awareness versus, where the level of investments are right now. Are there any, 2 or 3 things that you think the various ecosystem players, including SEBI, can concretely do to sort of, bridge this gap? On part of distributors, what are the 1 or 2 things that you would like to change? Anything in the regulatory anvil? And from the asset manufacturer's perspective, what are the one or two changes you would like to see?
So the first part, what steps we are taking and what do we expect from the various players in the ecosystem to increase investor awareness about the possibility of entering capital market and how to safeguard from these scamsters. Now, if you must have seen that SEBI was not very active on TV media, we have started advertising on TV, number one. Number two, that so far all investor awareness program was done individually by various market participants. For example, NSE will do it separately, BSE will do it separately, NSDL will do it separately, CDSL will do it separately. You know, those, they were doing it, but they were all disjointed. What we have done is we have put them all together, including MFI. MFI has also become part of this system. And we all contribute according to, there is a formula how we are going to contribute, and a large corpus has been built up using investor, each one of has that fund for investor awareness and all that. So we will use that fund to actually in a joint manner carry out investor awareness program, advertise on TV, advertise on radio, and actually go to various university colleges. We have tied up with Panchayati Raj Ministry of Central Government, and we are talking to various police of various states, and chief ministers of various states. So we are going to take them right to the grassroots level, designing an investor awareness program, covering various topics. The gist of that I have given in my opening address. How do we want to make people aware of the frauds that are taking place? The kind of enforcement that SEBI has done and caught various kind of scamster schemes. We want to tell those investors that these kind of schemes, how scamsters try to scam you and how you should be aware of these things. So once again, the idea is that we all together in a jointed manner will build that trust so that more people will come into the force. Your second question was about mutual fund distributor. We do feel that there is some kind of, regulation which is important because investment advisors are allowed to do investment advice. And when I say investment advice or research analysts also, that is advice about a particular security. Now, mutual fund distributors are only for distributions. They can give incidental about, they can, there are 4 or 5 funds are there and they can advise their client that you invest in this particular fund, but all that mutual fund, they cannot give security market advice. Now, this is important because that distinction must be maintained. If mutual fund distributors are not regulated investor advisors, they should not give investment advice. So that is a regulatory restraint which is there. How that can be implemented or can be improved upon, we can do discussion on that part.
Precisely what my next question was, because this distinction between mutual fund distributors and investment advisors is very, very thin. And I don't know how at SEBI you track this at all in terms of where somebody may be crossing the line. And also, given that in terms of transaction execution, a lot is going directly. There are tech platforms which do that also. How do you see the role of actual distributors on ground, individual distributors, evolving over the next few years?
So once again, as I said, we can look at this particular aspect and see regulation is one thing. How to implement the regulation is another aspect. We need to look at how do we make our implementation much better. And while implementing, if there is some changes are required, that can also be examined. But I think all of us will have to come together because, as I said, this all is going to be a joint effort. If there are some friction somewhere, we need to remove that friction working together.
Right. One last question. There is a lot that gets talked about, mis-selling by distributors of all kinds of financial distributors. Is there a framework or a surveillance framework under SEBI? And how do you track this? Is there some thought behind it?
So same thing, there is a clear guideline that you should not mis-sell, right? Now, one thing is that we do get complaints about mis-selling, and then we work on those complaints, and if we see anything is wrong, there are various stages through which we do enforcement. Initially, we do give advice because the purpose of enforcement is not that you have to take action. Sometimes you need to make sure that you educate also, the distributors also, that what is allowed within the parameter and what is not allowed. So that education is also equally important. So initial stage of enforcement is through the education part, that this is what you are allowed to do. And the harder enforcement comes much later. Right. But I think we are focusing on the first part.
Right. No, my question was essentially because, in terms of having a framework for, having checks and balances on the institutions, asset manufacturers, for example, front running, etc. The surveillance is nearly perfected by SEBI. So with respect to, the last mile, is there some sort of surveillance?
Yeah, so that surveillance, we accept MFI to do it.
Right.
Because mutual fund distributors don't register with us.
Right.
Right. So we don't track them directly. Our action is through AMCs. So basically, I think this is a role which we believe this AMC through MFI need to take it up. Right. About that regulatory framework and all. For the simple reason that we try to track things for which we get the data. I always say that, you correctly said that our front running and insider trading framework and other violation, we have a very good surveillance system where we use AI. In fact, I can proudly say that other enforcement agencies also come to our system. We show it to them and they get surprised at what kind of modern and futuristic surveillance tools we have. One reason I always tell them, I am from income tax, my previous avatar, that in income tax, we don't get live data. We get data at the end of 3 months when TDS returns are filed, or at the end of 1 year when annual statements are filed. So it is not something that we can work on live data in income tax, but here we get live data, right? Whatever is happening, that live data stock exchange is shared with us. And we can work on that live data to actually know, if something is happening, like one of that front-running case or insider trading case that we did where we found the violation of 173 crore. One junior, very young officer of our SEBI, through that surveillance tool, he saw something happening. And then we discussed and we went deep into it and we found 173 crore of insider trading. That kind of tools we have. So you're right. We have some excellent surveillance tool, but so far as MFDs are concerned, we don't monitor that data. So we don't have that framework here, but we expect AMCs and MFI to have that framework.
Sure. Thank you so much, sir. It was wonderful.
Thank you. Thank you, Mahalakshmi. Thank you. Thank you.
Thank you, Mr. Varshni and Mahalakshmi, for those insightful reflections on how credible advice and investor education can serve as a true pillar of financial inclusion. So yes, please give them a big round of applause. All right, let's move on to our next conversation, where India's participation in financial assets remains structurally low relative to its savings pool and demographic potential, even though the momentum has accelerated significantly in the recent years. Now, the next phase of the growth will depend not only on market performance, but on investor education, trust, and responsible financial advice. How do we widen access while strengthening investor confidence? And how can distributors play a pivotal role in guiding households from idle savings to disciplined long-term wealth creation? To share his perspective on this important theme, please welcome Shashi Krishnan, Director, National Institute of Securities Markets.
Good morning, distinguished guests and friends from the financial fraternity. Kamlesh Vashne, sir. So I think this session is primarily to sort of discuss and debate how distributors can widen access, build trust, and shift households from idle savings to disciplined long-term wealth creation. And I think Mr. Vashne, right at the beginning, set the context by referring to the SEBI Investor Survey 2025. And if you among the audience haven't seen the SEBI Investor Survey 2025, I would urge all of you to go and take a look at it, because it's got a wealth of information that can give us a lot of pointers as to what should we do to get more Indian households included in this investment journey. So looking at 2026, I mean, the view from the top is actually breathtaking. For decades, we have spoken about, India's potential in future terms. But today we speak about it in present terms, because I think by the end of this year, India will be the 4th largest economy in the world, and our nominal GDP will be something close to 4.5 trillion US dollars. And that is something like 400 lakh crores. So, I think this is a tribute to the 147 crore people of this country that we have now grown from a position of something like 13 to something like 4 in just about a decade and a half. But I think, we need to temper that with another very sobering thought, another very sobering microeconomic reality, because that's the macro. And that is, despite being a 4.5 trillion economy, the per capita income of India is still a modest $3,000. And if you look at it from any kind of scale, we're really not there yet. So while we're becoming one of the largest economies in the world, individual Indian households are caught in this paradox of wealth without growth, as I would say. And believe me, we are a nation of savers. We've got a legendary savings rate of something like 30% of GDP. But, we seem to be investing, with very ancient, paralyzing caution. And I think that needs to change. So if you look at that 34 crore households, which, the SEBI Investor Survey also refers to, just about, they save something like 18% of GDP. That's the savings rate that we have at this person, the household savings rate. But where does that money go? Only a very tiny sliver of that money actually comes into financial products. That's just 5.3% of that 18% household savings comes into financial products. And what about the rest? Because the rest of that is something like 950 lakh crores. And that, believe me, is lazy capital. It's really sitting in our lockers, sitting under our mattresses, really doing nothing, not creating wealth for ourselves, for the Indian citizen. And that's where I think the role of every one of you sitting in this room comes in. Because let's look at the scale of this, this physical asset trap, as I call it. Today, Indian households collectively hold something like 30 to 35,000 tons of gold. And at current market values, that's something like 450 lakh crores. Just take a step back and reflect. 450 lakh crores is higher than the 400 lakh crore GDP number. We hold more gold in Indian households than the GDP of this country. Let's look at real estate, because that's another physical asset that Indians love to hold. The total household real estate assets that Indians hold today is something like 500 lakh crores. And between gold and brick, and not the gold brick, but the gold and the real estate assets, we have 950 lakh crores. And that's wealth that is largely unproductive. And that's wealth that is not put to work. And I think the big challenge before all of us is to get that money to work for every single Indian citizen to create wealth for themselves. But even if you turn to the financial side, I think the story is still a little sort of disappointing. Because if you look at the RBI bulletin, January 2026, the financial assets that Indian households hold is something like 353 crores. Significantly less than gold, significantly less than real estate. But if you look at this composition of 353 lakh crores, 153 lakh crores is parked in bank deposits. And a whopping 35 lakh crores is held in cash. Indians love to hold cash for some reason. And believe me, 35 lakh crores is almost the same amount of money that Indian households have parked, the retail investor, the Indian households have parked in mutual fund assets. That's stated to be something like 41 lakh crores. So as much, in fact, till maybe the beginning of 2025, Indian mutual fund assets were less than the cash that Indians held. And that's the kind of cash that Indians hold in their that they keep in their wallets or in their cupboards or under their mattresses. And if you look at the money that's held in banks as deposits, they're mainly held as fixed deposits. And if you look at fixed deposits with inflation today ranging at something like 6.5% and fixed deposits offering you 6%, you are actually paying bank money to keep your money in the bank, which I think is a trap that all of us need to advise our customers and potential investors to get out of. Because it gives you an illusion of safety. But if you account for inflation, if you account for taxes, there is absolutely no real rate of return, and it just then cannot create wealth for yourself. We talk about the retail revolution. Numbers are always, thrown around. We say that the registered DMAT account holders have crossed 21 crore, the 21 crore mark. Look at it a little more, granularly, and you will see that out of those 21 crore DMAT accounts, only 4.5 crore accounts are actually active traders or investors. There is such a big gap for all of you to exploit in terms of getting them to participate in the markets. Look at mutual funds similarly, right? The total mutual fund folios have reached 26.6 crore. But the number of unique investors, just 6 crores. That's only 4% of India. So I think there is huge amount of opportunity for everyone sitting in this room to actually go out there and get more and more Indians to get included in the financial ecosystem. And I think it is this participation gap that we need to address. And if you can just mobilize an additional 10% of our population to move their idle savings from wherever it is today, cash or gold or real estate or whatever it is, you're going to add another 15 crore investors just by moving 10%. So I think the numbers actually give us a huge opportunity. So, the SEBI Investor Survey 2025, and I think I will, quote a little bit from it, had some very, very interesting data, which gives us a lot of pointers as to how exactly can we as distributors, approach this problem. So, the survey says that 63% of Indian households are aware of at least one security in the marketplace. Mr. Vashde referred to that. That leaves almost 37%, that is 11 crore households that are completely unaware that these options even exist. So when you break it down product-wise, just look at the contrast. the awareness relating to fixed deposits among Indian households is 98%, as against that for, securities, only 63%. The awareness relating to, life insurance, for example, is, closer to that 95% or so. So, sort of wind back to awareness relating to mutual funds, 53%. Wind back to awareness relating to equities, 49%. Look at the gap. So I think the first and big issue that all of us need to really address is awareness. The geographic divide is also very, very stark. If you look at the top 9 metros in this country, the awareness of the securities market, of equities, of mutual funds, etc., is close to 89%. And the moment you move away from these, these top 9 metros, the percentage drops to something like 56%. So again, there is a very, very big gap, and I think most of us in the distribution community seem to have concentrated on the large metros because that's easy picking. But I think the opportunity lies beyond that in the Tier 2 and the Tier 3 cities. You look at it from an occupation perspective, right? Most of us seem to be targeting salaried employees. In fact, if you look at the kind of inclusion that salaried employees have in the financial ecosystem, it is something like 81%, right? Again, drill down to agricultural workers, drill down to the unskilled workers, that percentage drops to below 50%. So I think there is a very, very big divide that is there, and I think one of the big jobs that all of us have is to bridge that divide. But I think the critical point is actually way, way beyond awareness. The critical point is that we need to understand that awareness does not ensure adoption. And that's something that this survey brings out very, very clearly. Because among the 21.3 crore households, which I talked about, who are aware of at least one financial product, just about 3.21 crore households actually invest. And that's 9.5% of the total Indian households. And why don't they invest? They primarily do not invest because there is this massive knowledge gap that exists today in India. And the survey goes on to say that only 36% of investors, I'm not talking about the people who are non-investors, 36% of investors have a moderate to high knowledge of financial products in the financial ecosystem. And about 47% of that of those people who actually participate in the markets actually admit to having low knowledge. So we actually have people participating in this market, but they are doing so in the dark. And that's one of the reasons that lead to so much of fraud, etc., which Mr. Varshney was talking about. So I think for 90.5% of the Indian households that do not invest, I think the barriers are very clear. And if we understand the barriers, we will also understand what the opportunities are. And I think the barriers are very clearly, one, that financial products are complex and confusing to most Indians. Two, they are overwhelmed with information, and with due respect to Moneycontrol, which gives out a lot of information, the retail investor is really overwhelmed with information, and there is an information overload. And thirdly, there is a multiplicity of choices. So the more choices you give people, the more paralyzed they become and the less probability that they will make decisions. And I think, fourthly, we have to understand that Indian investors and potential investors are afraid. See, we are a culture where 80% of households prioritize capital preservation above everything else. So the volatility of stock markets, the, daily movement of prices, the sort of moving up and moving down of the net asset values of mutual funds feels more of a threat rather than an opportunity. So they fear losing their principal, and they're put off by the uncertainty of returns, and as Mr. Varshney again said, probably there is a lack of trust and there isn't enough transparency. And that's where I think the role of financial distributors becomes very important, because in times of volatility, it is only the financial distributor who can handhold investors. And I think importantly, the survey also seems to suggest that 59% of investors actually rely on friends, families, and colleagues for investment advice, and 56% of them go to finfluencers, social media, etc. for advice. Only 25%, that is just 1 in 4, comes to a professional investment advisor or a mutual fund distributor to ask them for advice as to where to invest. And I think it's very important that all of us in this room sit back and introspect as to why is this happening. Because if we can crack that, then we'll get a lot more people coming to us to ask us for advice, and we'll be able to guide them much better. And this is especially true of the young generation. So, young adults in India today, between the ages of 18 and 35, are a very key demographic. They account for almost 47 crore individuals in this country. And, there are studies to show that 93% of young India who are earning actually save, and a few of them actually invest. So they have been making the journey from, what you call saving to investment. But a large proportion of all those people who invest actually turn to YouTube, turn to X, turn to finfluencers for advice. And I think the question that we need to ask ourselves is, why is young India finding it so difficult to reach out to financial advisors, to reach out to distributors like you for financial advice? And I think that the answers to this are not very difficult to find, because, in this internet age, it is much easier to access the internet than to access any one of you. And I think we need to sit back and say, why so, and how is it that we can sort of allow people to access us as easily as they can access the internet. I think the second reason is that customers are very, very unsure as to whether the distributor or the investment advisor is actually adding value beyond, product information and support services. Because today, in this digital age, product information, support services are available online. So you need to demonstrate that you are actually can give, some kind of services that are way, way beyond what, the internet can give. And that's the only way that you will have customers coming back to you. And I think that's a wake-up call for all of us, because unless, we make ourselves accessible, you make yourselves, you have the ability to communicate a lot more clearly and in simple enough language, or generate trust, you will not be able to compete with, the digital offerings that are there. So how do you widen access then? How do we build trust? How do we shift 147 crore people from, move their idle savings to disciplined wealth creation? And I think the answer to that is hand-holding. Because the survey that we did actually looked at what the non-investor, the people who are not investing in the market, actually had to say. And they said, what do we need? They said, we need easier processes. We need help with the boring stuff. We need help with account opening. We need help with KYC formalities. We need help with documentation. They said, we need simple, jargon-free explanation of how products work. We need, the distributors to guide us to lower minimum investment requirements so that we can test the waters and see whether we these products suit us. But above all this, they said, we need a trusted financial advisor. And I mean, you must realize that, Indian culture is deeply family-centric. So when an Indian mother saves, she isn't thinking about retirement corpus, in abstract, or creating wealth for herself in abstract. She is actually thinking about her daughter's wedding, or she's thinking about her, son's education. When a daughter saves, she's actually thinking about supporting her dependent parents. So it's a very family-centric kind of, saving and investment process. And therefore, we must stop selling products and start selling solutions that meet these family aspirations. And that's the kind of transition that every single distributor and financial advisor has to make. I think the other important, finding that the study threw up was that there is a big necessity to embrace the vernacular. Because the study showed that there is a very strong preference for communication in the local language. So if you need to reach that 44% of the rural, self-employed, people who are currently unaware of mutual funds and equity, etc., you can't do it, in an English-centric, Mumbai-based jargon kind of process. You really need to speak the language of Bharat. And I think as intermediaries, you people play a very important role because you're gatekeepers to this transaction. And, your role becomes very important. And I think, clients are looking for guidance. And today we are seeing the financialization of savings that is going in a very big way. And I think we will be the people who can take this entire process forward. And therefore, if you look at 2 or 3 mantras that we really need to embrace, one is we need to simplify the complex for the man on the street, in the financial, relating to the financial ecosystem. We need to go local. We need to build trust. So these are some of the very simple mantras that all of us need to embrace. Over the last couple of months, I have been doing a masterclass series with, many of the leading the leaders in the financial ecosystem. And there were 3, senior leaders from the mutual fund industry who I did speak to. Navneet Monot, Nilesh Shah, and Balasubramaniam, A. Balasubramaniam. And, they left me with a couple of ideas which I thought I must share with you in this room. Navneet told me one thing that I think still remains with me. He says, KYC can be online, but UYC, that is understanding your customer, can only be done by a distributor and a financial advisor. So believe me, don't think that because things are going online, the distributor will become, redundant, because only the distributor and the investment advisor can UYC or understand the client. The second thing that he told me, which I think struck me, is that, and he told me that it is only the distributor who can help the customer in her journey from data to information to wisdom. And only wisdom can create wealth. I think this is very important because there is so much of information out there, but how does a customer cull out wisdom from that information? The customer is not equipped to do that today, and I think the distributor is the only person who can handhold her or him to, cull out that wisdom and create wealth for themselves. I think the other thing that Nilesh told me was that people have trouble understanding themselves, which I found, very, interesting in the Indian context. And he says, very often people go wrong understanding themselves, And that is why there is a need for an advisor or a distributor, because the distributor and the advisor's main job in the years to come will be to help investors understand themselves. Because in times of volatility like this, in the initial opening round, we talked about the Straits of Hormuz and, the volatility in the markets, etc. I think that's the time when you need sort of distributors and investors to handhold you. And when I was speaking to Bala told me that, he's been doing these Bharat Yatras, visiting a lot of smaller locations. And he says that when I visit these smaller locations, I find that the financial awareness is very, very high. And people are very, very serious about wealth creation for their own future. But what they are looking for is some kind of hand-holding. And he said that is where the opportunity for every one of you in this room lies. So I think the future looks extremely optimistic and bright. And I'm sure all of you will be able to sort of take India to the next stage in the customer's financial journey. Thank you so much.
Okay, thank you, Mr. Krishnan, and of course, requesting you to be on stage. And thank you, Mr. Krishnan, and requesting Mahalakshmi to please come on stage and take the conversation ahead.
Just one question, Shashi, beautiful talk. This thing about India having low investments, especially in equity markets, and the fact that Indians have always preferred real estate and gold and the safety of bank deposits is so far been the truth, except that post-COVID we've seen some sort of surge in equity participation. The question today is, amid all this uncertainty, and when you see that stock markets have not performed for the last 2 years, on a single day, markets can go down 2% because of this uncertainty. And now we have not even seen the kind of correction we are used to, like in 2000 or 2008 or, in previous market cycles. And gold, which has been, something that everyone has preferred, especially Indian women savers, today has done so remarkably well that it is hard to sort of convince anybody to invest in equities in this environment. So in your view, if at all we were to shift the focus away from gold and fixed income and real estate into equity markets, what should be the messaging? How do you convince a mother or a common person to say that equity is indeed the asset class you should be investing for the future?
So I think somewhere in that entire conversation you said 2 years. And I think that's where we need to sort of question ourselves, because if you're creating, you want to create wealth for retirement, let me say, for example. Now, retirement for, I may be an exception, but for retirement for most people in this room will be 35 years down the line, right? Maybe for me it's already there, or 2 years down the line, or whatever it is. So you are actually looking at 35 years down the line, and the only asset class that can give you the kind of opportunity to create wealth for yourself over the next 35 years will be equity. I am not saying that gold hasn't done well in the last couple of years, because you will have periods of volatility, geopolitical instability, where people and countries will shift a lot of their sort of exposure to gold. But if over long periods of time, we have also seen that gold has not performed. So where you had peace and stability across the world, there have been very little geopolitical tensions, then gold sometimes just becomes an asset that is a dead asset and doesn't work. So I think the way we need to convince households that they need to move, more into risky assets is to tell them that yes, there will be volatility over that 2-year period, there will be volatility over a 4-year period, but if you're going to remain invested for 35 years, then the kind of volatility that equity has, and believe me, there are research studies that have actually looked at this very, very deeply. The kind of volatility that equity has over a 30, 40, 50, 100-year period is almost the same as what a treasury bond has. It's not much higher than that. And therefore, what is essentially what we see as short-term volatility over the long term is really not, a very volatile asset.
Thank you so much, Mr. Krishnan.
Thank you, Mr. Krishnan and Mahalakshmi, for underlining and, of course, addressing the structural gap of knowledge between investors and the participation that's required. But yes, moving on to our next conversation, the India's GDP growth continues to be among the strongest globally. Domestic institutional flows are helping anchor market stability, and the mutual fund industry is seeing a steady growth in retail participation alongside improving earnings visibility as manufacturing and capex have picked up. But the real question is, how durable is this momentum? Are domestic investors now the stabilizing force in markets? And what does this mean for long-term asset allocation in India? To explore this, please welcome Nimesh Shah, Managing Director and CEO, ICICI Prudential Asset Management Company, with a warm round of applause. And joining him, Mahalakshmi, to lead the conversation ahead.
Thank you so much, Lavisha. So, the first question, of course, Nimesh, thank you for joining us for this very first FiDEX event. This is a very important moment for us, and great that you could make time for this. The first question on everybody's mind is, ever since the Russia-Ukraine war happened, we've been talking about geopolitical uncertainty. In a sense, that uncertainty is now a certainty. The event has happened. And at the same time, it would not be inappropriate to say that this creates a fresh layer of uncertainty in terms of what is to come across the world, what happens to India. And then in the, I don't know if I should say the periphery or center stage, is also lots of conversations around AI, other threats to markets, which are micro, macro, India-centric, global, all of that. In this whole situation, how does the mutual fund framework really change in terms of how investors look at investments in mutual funds?
So we have been, I'm stunned by the scale of event. When Mahalakshmi told me that I'm supposed to come over here, I said, normally commodities and all happen, or interior design melas happen. I've never seen a financial services mela. So you guys have pulled it off. And I'm just seeing the amount of interest. I met a lot of people from outside, and everybody was asking me as to what will happen and where should they be investing, etc. So I think it's, we didn't understand the need of this, but you guys understood it better than us. For us, it is always, things are very obvious. You mentioned one line which said it all, that uncertainty is certain. Right? And we have always been mentioning that in a different way. You worded it quite well, that uncertainty is certain. But that's where the world is today. Before we start the conversation on what we have to do, let us see where we are today. What has been happening around the world over the last 1 year and what is happening today is that if you see, our focus is on where are the interest rates heading, where are the interest rates in the West heading. And that indicates a lot. If you see in the last 3 months, interest rates in the US are inching up. That shows that something they know that we don't know, right? The way the bond market is operating in US and the way the equity markets are operating in US, it looks like they are looking at 2 different countries. I always, in my last 30 years, I have seen that the bond markets are always very logical, and the bond market indicates of what is going to happen. So it is an uncertain world in US with interest rates, if they go up, how everything changes for us. And in that scenario, whatever is happening, India is a great place to be. Because fortunately, or we have discussed a lot about decoupling and coupling and all, but fortunately, our industries in India or our markets are not getting so impacted. We are a country, remember our decoupling stories that we used to have. We are a country where industry is quite insulated from what is happening in the world because essentially the market for our companies is basically India. But our financial and investment world is completely connected to what is happening in West. So that is what it throws opportunity also. The real world of India, whenever people were asking me 2 months back, all the questions was what will happen because of the tariff. And we were explaining it with the numbers that tariffs don't affect India so much, right? Because if at all $30 billion of exports was getting affected in this country. And $30 billion of the GCC growth in India is more than that every year, right? So whether we like it or not, we are not a great export nation. So in manufacturing goods, services we are doing well, GCC we are doing very well. But in manufacturing goods, anyway, we are not great. So the world impact on my industries is not that high. That's what I have been explaining people, that industry is not getting affected, but the investments world will get affected with what happens in the world. So we are in a very uncertain world, but we are in a very stable island called India, which is very beautifully situated today. Look at where we are today, as a country where we are today. So uncertain world, uncertainty will increase, uncertainty will continue. But in India, where are we today? Right? It's a very, we are in a beautiful, what has happened in the last 3-4 years, or as you said, last 2 years, there has been no return. Why has there been not any return in the last 2 years? Because the government had controlled the expenditure. They have been fiscally very, very prudent. And when they came to power again in 2024, there was a lot of fiscal control that happened. Our fiscal deficit is very well under control. Our current account deficit is very well. I have never seen a time where fiscal deficit is good, current account deficit is good, bank balance sheets are strong, corporate balance sheets, there are hardly any borrowing. So India overall is in a very good phase where we don't have to worry of what is, because most of the consumption is also in India. So I think in a very volatile world, we are in a very stable place, which can, and best part of it is that the government has done everything front-ended. Look at the year 2025. Calendar year 2025, the government, whatever the government had to give on the indirect spaces, government has given indirect taxes. For GST, concessions have been given. Whatever had to be done on direct taxes, the middle class has been rewarded. You are talking about 1 lakh crores each. GST has given 1 lakh crores. Income tax benefits have been more than 1 lakh crores. So this too, plus liquidity had to be put in. RBI has put in liquidity. Also, a lot of controls had been put on personal loan and all, which have been relaxed. So whatever had to be done from the government side has been done upfront. Investment world, we were slightly overvalued, and we used to say it quite openly that in 2024, we were quite overvalued. Last 2 years, earning per share has increased. Almost every year, if you see, almost 17-18%, the EPS has increased over the last 2 years, and market are exactly where they are. So today we are in a situation that we are at par with the last 1 year. The entire emerging market has grown almost 38%. Some of the markets have grown by 70, 80, 100%. But India has not grown. So vis-a-vis, we were expensive vis-a-vis the world. Now we are not expensive vis-a-vis the world. We were expensive vis-a-vis our own history. Now we are not expensive vis-a-vis our old history. So in an uncertain world, India is a stable place where uncertainties are relatively lesser than the rest of the world, and the past 2 returns has been July 2024, the markets are at the same level as we are today, but the earnings have grown. So the extent of overvaluation that was there in our markets is not there today. So we are in a stable position.
If I were to play devil's advocate and look at each one of these points from a opposite angle, the government has and the RBI have done everything that they could. They've thrown everything at it, and yet earnings have not come back the way we thought it will come back. Because from December onwards, from September onwards, we've been saying that, next quarter will be good, but it's not really taken off in a big way. AI threat gets more and more severe.
Can I respond one-on-one?
Okay.
First thing, she has talked about earnings. So good it's that she's playing the devil's advocate. Earnings, if the government as the economy takes time to revive it, does not that you push a button and immediately things happen. So in the year 2025, government has done the infusion that they had to do. I think the impact of that we'll see in the year 26-27. So you can't see a quarter to quarter tak. You have to see year to year. And both the years, if you see the last 2 years, the CAGR of earning has been 8%. If you see it from March 24 to March 26, the CAGR of earning is 8%. If you see the brokerage houses reports, which predict earnings, I am not in the, but the brokerage houses report expect a high teens earning growth in 26-27.
Yeah, the consensus on Bloomberg is, 12%, but in my 25 years of tracking markets, every year the earnings growth for the next year is 12 to 15%. So the second point is the AI threat.
On that, see, ultimately, Indian markets, look at the last 10 years, look at the last 20 years, the country is growing at a nominal growth of 10 to 11%. When the country grows at a 10 to 11%, the top corporates of India were growing at around 13%. If you see, ultimately the markets follow earning per share. Earning per share over the last 10 years have been growing at around 13%. So if the earning per share grows by 13%, the markets will grow by 13% over a long period of time. So 10 years, so if in a year, if the market is giving 25% return, why do we get surprised that next year there is no growth in the market? It is natural.
From the valuations that we are in today, last year, ICICI Naren was when the small caps peaked out, pretty much he was on time in sort of warning investors that it was a frenzy. From current levels, do you think it is we are ready to grow at earnings rate, or does it require further a flattening for us to pick pace from there? Because one of the things about all market cycles is, as market overshoots on the upside, it could also undershoot on the downside, overshoot on the downside, which means, and we are right now in terms of valuation only in the middle. So if we see overshooting on the downside for next 2 years, especially because one is earnings, the other concerns are AI, which is, you see it in IT stocks now. But the impact of, what it could do to a lot of businesses is still in question, maybe slightly premature. What we were talking about as India's advantage, that we will be able to navigate this multipolar world, etc., has also come into question after the, tariffs and so on. So in this ambience, is there a case that India will not overshoot on the downside in terms of valuation? The only exception to this, the arguments most funds and fund managers make, is the money flow is very strong. But for that, let us just keep that aside for a moment and say, fundamentally speaking, is there a case?
So a lot of areas you covered, flows, everything, earnings. So we'll stick to earning. Give me one by one, I'll answer one by one. So as I said, we believe with whatever the government has done, the economy takes time. It is not immediate. It does not happen in the next quarter. But whatever leverage the government, and look at the indicators. Are we selling more cement? We are selling more cement. Are we selling more power? We are selling more power. Power consumption in the country is increasing. Cement consumption in the country is increasing. Homes are being built, right? And the fourth one is that autos is doing well. So auto is doing well, home is doing well, cement is doing well, power is doing well. If the consumption of all this four is increasing, I look at this four on my dashboard, every month I look at these 4 indicators, and these 4 indicators are enough for me to say that the industry is doing well, the economy is doing well. So we believe that the economy is positioned well, And the impact of that you will see in the year 26-27. I'm repeating the year 26-27.
Okay. The counter to this will be, but this will become an endless debate. The counter to this will be, 25% of Nifty is banks, 10% is IT, 10% is consumer, 45% is not growing at the clip that you would like to see, which justifies the valuations we have. So a quick rebuttal to that. And then, there are bigger questions about the industry, how categories are going to evolve, etc., which we can move on.
So market always overreacts. As many reports that you see on that software will be impacted. You see as many that in the short term at least, right? In the short term at least, a lot of engineers and a lot of our companies will be required to make the changes happen. So AI, everybody talks about AI. Right? Even in my company, we talk about AI and we see AI as is bringing in efficiency. Where I required 15 people to answer emails, I require only one person because the AI replies to the email very efficiently. On the investment side, it is very, very interesting. We are in the process. There are three things in investment. You do research, you do analysis, and you take decisions. The first part, research. Will we be able to remove search from research? Right? We are also working on that. That to a great extent, a lot of search that was happening earlier, that will be removed from research. Right? Still, we are talking about that in India, right now, the decision making as well as analysis, while AI can do a lot of things, we are only at the stage of doing search with AI. Decision making is still not happening on AI. Right? So it's a work in progress. Only in every area I see in my business, efficiency is only improving. Right? And it is only the start. I believe efficiencies can improve further and people can be used to do better jobs. Right? The same thing we were talking when computers came. When I started my career, I had to go through a bank demonstration. Banks were objecting to computerization happening. It's very similar. The changes will happen and we'll manage the changes as they come.
Right. Now, moving on to flows, first of all, if you look at the AMFI numbers for last month, the money, the total assets under management under gold is now about 3 lakh crores. Nobody would have imagined that. And presumably, a lot of this money really came chasing momentum in gold. Now, how do you see money flows, into markets over the next 2 to 5 years? Do you think if markets were, let us assume, it were to be flat or underperform, do you think the nature of flows first of all, will the flows into mutual funds continue? And will it move away from equities into other, performing assets, for example, gold? How do you see this whole dynamic working out?
See, one macro number, I'll quote only one macro number, 250 lakh crores. We as, you as money managers, our jobs are exactly the same, right? You do asset allocation, I do asset allocation. In addition to that, I also pick up some stocks. That's the only difference between your business and my business. And I believe that our business opportunity is infinite because we are talking about 250 lakh crores sitting in bank deposits. Right? Bank deposits, the returns the customer is expecting. What is the Indian customer needs? He wants stability, he needs certainty, and for that, if he is getting 6 to 7% return, he is okay with that. Now in a country where the nominal growth is 10 to 11%, right? All our products, if you see the investment product, there is only one product in the mutual fund industry. The mutual fund industry helps the customer to beat inflation. You have got from 1 crore customer in 2018, we have reached 6 crore customers. The customers have got a good experience with the mutual fund industry, right? And 30,000 crores is coming in a SIP every month. Even in a year, we have got 2 years where the market is exactly where it was, but the inflows into SIP is growing. I think you all have done a brilliant job in educate the media also and the distributors also in educating the customer that if he has to beat inflation, he has to be in capital markets. If you don't understand stocks directly, then go through mutual fund. We all have been saying the same thing since 25 years, but it has resonated very well. So the online channel saying it, the media saying it, the distributors saying it, everybody is working for us. The mutual fund Sahi Hai campaign also increased that a lot. In a year where markets have not given any return, the SIPs have moved from 25,000 crores to 31,000 crores. I did an IPO some 3 months back, and every time, if there was not a, I would have done 100 roadshows across the world, and people in US, people in Hong Kong, people in Singapore, people in Middle East, everybody asked me one question about the SIP flows. Will they continue? Will they not continue? What will happen to the SIP flows? Because as you said, it is supposed to be a stable. So today the DIIs, the domestic institutions, are strong enough that if the FIIs want to exit, they can exit, and we are giving them an honorable exit. Right? Because the kind of inflow coming in is quite stable. I didn't promise anybody that this is going to go on increasing. I said in my every roadshow, I said that if the returns continue this way, there can be slight correction in the SIP. The SIPs which have come online, where they might not have invested in the right product, where wrong sales has happened with unrealistic expectations, that can slow down, right? That can stop, and that should stop. So wrong sales will stop. I'll give you 2 examples, and I might take some time, but I'll give 2 examples. One example is of a distributor who does not sell SIP, and lot of financial distributors who have to face the customer 3 to 5 years down the line, the quality of sales has improved big time. Right? They're very responsible selling, because all of us know that we have to meet the customer 3 years down the line. If I tell you something over here, it has been recorded everywhere, and I will have to face you 3 years down the line. Mahalakshmi herself will ask me the questions 1 year down the line. This is what you said 1 year back. So we have to answer the customer 3 years down the line. So this community has sold the product very, very responsibly. So example of that, most of the distributors are doing goal-based SIP. So when there is a customer, I have seen this live, a customer has asked for redemption, and the distributor asked him, should I remove the funds from your retirement plan, or should I remove from your daughter's education? Invariably, the stoppage of SIP stops. The person continues with SIP. Right? So anybody who has sold responsibly, and that is data also saying that distributors who have sold responsibly, there are no stoppages in SIP. But I had a nurse in Hinduja Hospital. My father was in Hinduja Hospital, and there was a nurse in Hinduja Hospital. She came to know what I do. She came and showed my portfolio to me. So she had come through an online channel, and she had selected a fund which has done well in the last 1 year. So she had selected 2 PSU funds in 2022-23, 2 PSU funds and 2 small cap funds. Now those will stop because her entire portfolio was negative. So the good thing is that mutual fund has reached the nurse in Hinduja Hospital. But the bad thing is that she has only seen last 1 year performance and invested in it. So if we, and I am also worried about gold, right? There's nothing wrong in investing in gold or silver. One should have asset allocation towards gold and silver. But getting into it after your neighbor has made money, the whole world has made money, and then increasing allocation is the thing that we as responsible citizens of this country, and that is where you are required. Right? You are required to tell a person that do not look at rear view mirror and drive the car. Right? This is the problem. This problem in India is not gone. That do not people look at the rear view mirror and drive a car. People look at past performance, and that is the only indicator. There are things which are way beyond past performance. If we are able to do that, the distribution industry can do great investment counseling to the investors.
Absolutely. And this is not just an India problem, right? People look at the rear view.
It's a psychology problem.
It's a cycle, yeah.
Pro-cyclical is a psychology problem. So we have to create products which are counter-cyclical, and you have to sell products which are counter-cyclical.
Fair enough. So, so you spoke very highly of all the distributors, but all the distributors are complaining that their margins are getting squeezed. Over the years, you know, the margins for distributor commissions have been coming down. Now, and also the other challenge is the, you know, a bunch of technology platforms.
Let's
and
fix
also
margin.
And also investors coming directly through your websites and through the direct route. So people who are actually working hard, you spoke highly about.
Ask me, I'll answer everything.
This is the only question. This is the only question. How do you respond to the fact that the commissions are coming down? If they were to make a career.
Let me address that, then it'll come to the next one.
This is all the question.
Okay. So first thing, the best part of this industry is that we are very fair to the customer. I'm very proud to say that my funds charge the least in the market. Because the size of the fund goes up, you charge less. And that is why my business is very strong. My margins keep on going down every year. Every year my margins go down by 3 to 4 basis points. And I'm very happy about it. Because India is not a place to make maximum margin. In a growing industry, India is a place of increasing volume. So last 7 years, every year my margin has gone down by 4 basis points, but my profit has been going up every year because the volume compensates the margin. I believe that mutual fund, we have been very strongly and very well regulated by the regulator that we are not allowed to charge more, and that is the reason mutual fund has become a pull product from a push product. When I have been the CEO of this company since 18 years, and when I joined the industry, it was a push product. Today, people are asking for it because people have got a good experience about mutual funds. So, it is a pull product as much as it is a push product. And this has happened because we have done well for the customer. We have charged less to the customer. See the world where we were charging upfront commission to the customer. When a mutual fund was sold, 20 years back, 15 years back, we were charging the customer upfront. 100 rupees was investing with us, but 2 rupees was taken out as commissions upfront and was being paid out. So lesser we charge to the customer, better is the product and more sustainable is our business. Because the customer will have good experience, we will grow in size and we will not be eaten away by the passives. If we charge more and we don't beat benchmark, our dharma is to beat benchmark. If we charge more and if we don't beat benchmark, the passives will eat away my business also and your business also. Right? So it is very, very important that we charge less. Any product which charges more than the mutual fund industry is charging is not good for the investor. That industry will not grow. So lesser the AMC pays you, the better it is for your customer and better it is for your business also. So instead of choosing a fund which charges maximum to the customer, we can pay you more only by charging more to the customer. And that is not good for your business. A fund which charges less to the customer, it is good for your business. We should earn less margin so that we can compensate with the volume. So very, very clear on that.
So you also made a nice pitch for, large funds because they charge less. But Nimesh,
but they charge less, so they perform better for the customer.
That is debatable.
Data.
Is debatable.
90%.
Smaller funds.
Okay, I'll give you data. 90% of my funds are 4-star and 5-star rated. Right? Because we charge less.
But funds under 3 years are not even rated. So there are, a few star fund managers who've come in and they've got fantastic track records in PMS, AIF. Their funds are not even rated today because they, for
so
them
we
to be
finish
rated,
mutual funds will come to
years.
PMS, AIF also.
Right.
Right? So let's finish mutual funds. Let's not mix issues.
No. So, I'm saying this 5-star rating because generally smaller funds definitely have a better case of outperformance than very large funds.
Come again?
Small-sized funds.
Data does not say that. I have got small-sized funds also. Okay, in ICICI Prudential, there is no bias. I have got very small funds. I have 3,000 crores. I have got 5,000 crores. I have got 10,000 crores. I have got 70,000 crores fund. ICICI Prudential Large Cap Fund is one of the biggest in that category. It has beaten the benchmark and it is doing better. It is a 5-star rated fund. So there is no, it is the quality of fund manager and how the fund manager changes his mindset with the change in size. One thing I can brag about, my funds were 2,000 crores also, they were 20,000 crores also, and today they are 70,000 crores funds. The way we think when we are managing 2,000 crores, the way we think when we are managing 50,000 crores, it has to completely change. Right? So if you change the way you think, and the way your processes change, Processes have to change with the change in size. So there is no data to say that there is an advantage. I have got small also and I have got big also. Some big are giving better returns than the small also. So there is no such thing.
Fair enough. One last question on this, life cycle funds that SEBI has, the latest SEBI circular talks about. How do you see this evolving? Because one of the concerns that I pick up from people is that if, funds will offer life cycle funds, what is the role of the advisor? Because you're already pre-bundling a product and you have done some element of financial planning for the investor. What is the role of the advisor then?
Trust Mahalakshmi to convert a very great opportunity into a controversy. Huh? So
this is
a
genuine concern.
I am very happy. I was very happy doing IPO interviews also with you. So I think life stage funds are going to completely change the industry. The scale of the industry is going to completely change. We have been asking for it since last 15 years that give me life stage fund, because the customer is investing in life stage. He wants to invest either for his child's education. What do you guys do for SIP? You do the customer's goal. Whether we do it or not, whether SEBI allowed it to be done, they have always been doing the IFA, the individual financial advisor, has already moved to goal-based selling, right? So he is already selling retirement funds, or he is already, need of the customer is retirement, need of the customer is child's education, need of the customer is his child's marriage, need of the customer. So anyway, they have been doing it. So that coming into the mutual fund industry is simply growing to grow volumes big time, right? Suppose we come with a fund which is going to get over in 2035. Somebody is going to retire in 2035, he'll go for that fund. Look at what was my balance advantage fund? My balance advantage was nothing but retirement fund, right? But we do not call it retirement fund. But balance advantage fund was a brilliant instrument for retirement, right? A lot of people who were retiring were putting it in that. So ultimately it is equity and debt. One of the things that we have done very well as a company is dynamic asset allocation, and we are strong believers of dynamic asset allocation, right? So today in the market, with the uncertainty in the market, you have seen dynamic asset allocation over the last 15 years, and ICICI Prudential has been talking about dynamic asset allocation since last 15 years. You mix equity and debt in certain proportion. Even in life cycle funds, we are going to do the same. Right? So it's a brilliant asset class. It will grow the market big time. Don't worry, the customer has to be gone and shown that product, that if you are going to retire in 2035, or if your child is going to go in college in 2035, then please invest in this 2035 fund, or please invest in this 2040 fund. You are going to retire in 2040 fund. So I think it is a brilliant model of mixing equity and debt, and in an uncertain world, in an uncertain market, dynamic asset allocation has proved to be a very good category. Whether it is ICICI Prudential Balance Advantage Fund, ICICI Prudential Multi-Asset Fund, all of them have now got 15-20 years track record of doing well. Right? So it's a good category. Lifestyle is nothing in extension of that only.
So advisors should not be worried about it.
It is an opportunity. I'm very excited this opportunity is coming. We have been talking about it since 15 years. Finally, we are getting it.
Thank you so much. It's always such a pleasure talking to you, Nimish. Thank you so much.
Thank you.
Thank you, Mr. Shah and Mahalakshmi, for a wonderful conversation. And the key takeaway has been that, in a volatile times when the market has been filled with so much of AI scare news and the global tariff, India still stands to be resilient. So yes, a big round of applause for them. All right, let's move on to our next conversation. Let's move on to our next conversation, where India's structural wealth opportunity and India's investor base has expanded significantly in recent years. Yet, a large share of household savings still sits outside the formal financial markets. Bridging this gap requires a stronger ecosystem, one that combines robust market infrastructure, accessible investment products, and a credible financial planning. As millions of first-time investors enter the system the responsibility of building confidence and guiding long-term wealth creation increasingly rests with distributors, asset managers, and advisory professionals. What will it take to bring the next wave of investors into the markets and ensure that they stay invested for the long term? To go deep into this conversation, please welcome Surbhi Upadhyay from Moneycontrol. Joining her are Anuj Kumar, Managing Director and CEO, CAMS; Mohit Bhatia, CEO, BOI Investment Managers; JP Chandrakant Surekha, CEO, FPSB India; and Jatinder Pal Singh, CEO, ITI Mutual Fund. Give them a big round of applause.
Good afternoon, ladies and gentlemen. That was a fiery session with Nimesh. He always charges up the room and sets the stage for the next round. And for that, of course, I have this panel of industry members and people who are very much part of that whole financialization story of India, the retailization story of India. So the stats are very well known, right? And we've been fairly proud of those stats. All of you, of course, are very proud of those stats as well. What a historic year 2025 was for the Indian capital markets. From an era, I mean, my career itself is now 2 decades old, and from an era of being absolutely dependent on FPI flows, just watching that number every day, and that number deciding the destiny of our market, we've come such a long way where FPIs went ahead to sell almost $20 billion in a year, and the market did not capitulate. And the numbers really say it all. I mean, 18% ownership of the Indian capital market now resting with Indians, whether it's HNIs or retail, and about 16% with foreign investors. Of course, this is not about that competition, and the scale is growing. 80 lakh crores of AUM across mutual funds, almost 40 lakh crores across PMSs, including, of course, the EPFO. But the question is, how much further? And here, gentlemen, I mean, an admission from my side, one stat really struck me. So I saw the number of, say, mutual fund AUM as, as a proportion of GDP, which in India now is roughly 20%. And I thought, okay, that's pretty decent. But when you contrast that with developed markets like Canada and US, and I realized those markets, that number is going to 100%, I mean 120% in some cases. So clearly there is a very, very, very long runway, and the journey has only just begun. So what are the twists and turns that this journey, this financialization journey, this retailization journey, what will it look like? What are the twists and turns we should be aware of and prepare for? That is what we're looking to discuss with our experts here today. So I want to open by, first of all, understanding from you gentlemen, what is the characteristic of this retailization revolution so far? This journey of owning 18-19% of our capital markets, a lot of people from perhaps tier 2 cities, is it a lot of new investors, women investors? What have we learned so far since COVID, and where do we stand? Let's understand that first. So if I could open with you, sir.
Okay, thanks for having us here from Bank of India Mutual Fund. So Sumit, like you rightly pointed out, there's been a lot of change if you look at the immediate 5 years, 10 years. But yes, if you look in the context of the larger picture, and of course, when you compare with the developed markets, there's so much ground to be covered. But I would think that the journey's started, the runway for growth for market-linked products. So when I say mutual funds, I would also like to include other market-linked products where there is a sense of uncertainty, which investors in India have typically not been comfortable with. But if you look at what we've achieved so far, and having been part of the mutual fund industry for 25 of my 30 years, I can proudly say that the mutual fund industry has played a very, very big role. The whole ecosystem, I must thank all the distribution partners who've played this part in the journey. And SIP, like Nimesh, our previous speaker, said that on all his road shows, one of the big questions that came to him was, how solid is the SIP? So that's what we've been proud of. I think the journey that's been achieved has been, and one of the previous speakers also pointed out about what is the penetration of financial products and penetration of market linked products or equities. So equities currently would be about 6-7% of the overall household assets of about 1,200 lakh crores. But yet, what we've seen is the growth that you've experienced over the last 10 years. So the trajectory has been set. And more importantly, if you look at mutual funds, while we always say that don't look at the past to assess the future, but I think a strong track record of about 35-40 years has been set. Right? People see that, people have experienced it, people have experienced the power of compounding, at least in the top 30 cities, right? And with a lot of the regulatory, I would say, changes that have been brought about, making investing in general and mutual funds in particular very, very investor friendly. You've seen that trickle down to the B30 levels also. I can say that because at Bank of India Mutual Fund, we've seen some very fast growth in the B30 assets. In the last 5 years, our assets from 1% became 27%. That was also the highest growth in the B30 segment in terms of percentage terms. So, I mean, there is adoption. It could be much faster, but I would say that, yes, that's something that has happened. We've seen SIPs of about 9 crores in terms of these SIP numbers or inventory. In fact, Anuj is there. He can throw more light on the data in terms of what's happening. But increasingly, I would say, while it's good to look at what we've not done, but I would really think that with everything that is happening, so for example, the regulation, transparency, the fact that people have gained a track record of about 30-40 years in terms of their experience of mutual funds, in terms of the tech stack that we have to enable access and quicker access, and in terms of the transparency that the mutual fund industry brings forth, there is so much that has been done, and the runway is fantastic.
Okay. Great opening points. Anuj, if you could come in and actually let's straight away get to that debate. That SIP number that Nimesh mentioned, it's a very heartening number, and I look at it every month as well, right? 31,000 crores, so steady throughout the ups and downs of the market. But there's always that debate about the SIP stoppage ratio of, that's the gross number, and really will redemptions pick up if the market doesn't pick up? What does the data tell you? And when you look at the stats and when you just talk to, the ecosystem around?
So, first of all, thanks for having me over as part of the panel. I'll perhaps try to answer the first point that you raised, a bit of that, and then get to what you're mentioning now. I think I spent about 10 years in the domestic MF market, came from outside, came in when the entire investor base was just about 1 crore people. So the formal commencement of the industry, there's no date, but let's imagine it was the mid-90s. Mid-90s to about 2016. It took more than 20 years to get the first 1 crore investors. I was one of them because my first ELSS folio is from 1998. That was the time when PPF as a guaranteed instrument used to deliver 13%. PF used to deliver 13%. I think in PF there was monthly compounding too. All of this was government guaranteed tax-free, and your ELSS account had to compete with the 13%. All of those returns have fallen in the government guaranteed part to about half. But I think over that period of time, we did not see the growth. The industry was doing more or less whatever it is doing today, which means it was creating a tax-efficient, transparent, high return kind of investment architecture. But it wasn't bought as much as it is bought today. And I think the one difference which has happened is not in the what of the matter, but in the how of the matter. And I think 3 or 4 things helped. One, the proliferation, and I've said this many times, the proliferation of smartphones helped. Cheap smartphones costing less than 10,000 rupees, second-hand phones costing 5,000 rupees. Internet packs of 100 rupees helped. And I think in one fell swoop, you completely took out the gap between the smaller towns and the larger towns. We named them as B30 and T30, but you could give any nomenclature. I think that thing has gone away completely. Today, when you see kids watching the same YouTube videos in Delhi and also in, let's say, Meerut, they perhaps have the same twang in terms of how they speak English because they're watching the same YouTube content, and the gaps have been taken away. So that's one. Secondly, onboarding, we must realize, used to be a bit of an effort. Successively at every point, You could do it through biometrics, you could do it through an Aadhaar OTP, you can do it through DigiLocker now. The journey has been simplified, and every website that you go to tells you that you must start with a PAN and Aadhaar. It's going to take you 5 minutes, and you will need to take a live picture. Please be prepared for this effort. It just spurs a lot of us on to start doing these things. So I think the how mattered, which means a lot of people entered the arena. The ones who entered the arena, by the way, my personal view is haven't taken action yet. They haven't taken serious action, which means the 6 crore investors have started SIPs, but have they contributed, let's say, 3, 4, 5% of their savings or their wealth? I do not think so. It is still concentrated in a few hands. And a lot of these people, have they graduated to the second or the third product? They haven't. So what you're seeing is these 31,000 crore of SIP money coming in, first of all, is an absolute reality. This is money in the bank. There is no hypothetical component to it. It's real. This is after a 40% year one attrition. So 40-45% of year one attrition has been accounted for, and then the balance SIPs, the ones who stayed on and the ones who got registered recently, are contributing to 30,000 crore. And in an industry which has, let's say, net sales of 6, 7, 8 lakh crores, 8 lakh crores in a great year, if about 3.5, 4 lakh, more than 50% or close to 50% starts coming from SIPs, I think that's one single habit that you're given a mandate and you do not review it. You're not taking the decision. The decision is taken once and you just continue staying with the decision. That's 60% of the market. The balance 40% of the market is more evaluative, and they look at these things a lot more frequently. So I think
so let me ask this. I don't know if there are straight numbers to it. That number that we get, 31,000 crores as of last count, is bulk of that existing investors simply continuing their SIPs? How much is it new SIPs opening and new investors coming in? I mean, I don't know if there is a straight division that is available.
No, it is. So if you take just CAM service funds, we get about 1 crore to 1.25 crore new SIPs in a quarter. If you take the industry, that number would be in between 1.5 to 2 crores. So the number of new investors coming in and new SIPs coming in is very large. And I think that is one of the mainstay of the industry. Again, I would just underscore the point that this is after the 40% attrition. So one immediate priority for the industry is to figure out, we're hearing about performing products, we're hearing about low-cost products. If we are able to fix this 40%, then I think, or a part of the 40%, we'll never fix the whole of it, then I think from a sentiment and commitment perspective, it gives just a large fillip to the entire thing. It makes the industry more productive because you don't have to sell again and again. You've sold once and you're able to get the investors to stay kind of fully committed. And the second point I would say is that just in terms of product diversification, if I look at data, a lot of our investors have tried only one single AMC. Inside a single AMC, a single product. The equity holders haven't been sold debt, and a lot of that vice versa. So the ability of this community which is sitting here, which is advisors, distributors, influencers, all of them, is to just show this simple path. I'm not talking of any complex long-term goal setting. Of course, all of that has to happen. But I think simple habit forming of staying committed with SIPs, seeing your long-term returns, entering your second product when you're in the mind frame to do it, I think are simple habits which make a big difference to how investors behave.
Okay, fair enough. Mr. Singh, so just taking the conversation forward, अब आ तो गए हैं investors, रहेंगे कि नहीं? I think that's the big talking point now, right? Because the market has been tough, and a lot of the newer investors that Anuj also alluded to, especially the ones who came after COVID, have seen superlative returns, right? It's the first time that perhaps many of these young new investors, young or old, essentially new investors, they're seeing range-bound markets continue for a while, red portfolios continue for a while. What is your read-through of the amount of money that's come in, and whether it's sticky money or whether that money will be now FOMO money and it will start looking for other houses?
Surya, I think this question might have been valid in every market cycles. So when we were 1 crore investors, we would have thought, how will we go to 2 crores? And we are 6 crores plus today in unique PAN base. So I think it is welcome as long as the gross flows are there and more investors are coming in and the net accretion is there. We don't mind the gross, and some of the people, I hope not leaving but churning maybe. Maybe they are not being handheld, and because a lot of the people who are coming on platforms maybe just chasing a product whose past given returns. So there is a hindsight or a recency bias attached to the product, and they're coming in and chasing that. So my guess, a decent advice towards this in terms of handholding, what I tend to say is communication and clarity and alignment to long-term goals. This is what needs to be anchored for the investors. Now, if investors are going to come direct, welcome, not a problem at all. Right? We cannot stop it because digitization has taken up so much in the last 4 or 5 years. This is a reality for the world, for every industry. Why only for us? But thing is, going back to what you said, whatever be the reason, as long as people attach quality requirements and the goals of their lives to the investments, I think they'll become more long-term oriented. So it is a matter of behavior. So for the distribution community, and actually it is rule for us also, as long as we can do financial stewardness towards goals, I think the quality increasing itself will it will make the investors stay longer and attached and not be attached to some of these very short-term, things which I may not repeat, which happen in the market.
And that is where I must say the January inflow data was a bit of a shocker and a setback for me as well. I must say I was very disappointed. And the reason I'm sure everybody knows, and I was asking myself that, for 15 plus years, we in the media have been talking about exactly what you're saying, goal-based investing, asset allocation, being prudent in the way you're looking at money. And I'm sure this entire community here, everybody who's here in this exhibition hall has been doing that. But then you see January 2026, despite all of this investor education, 25,000 crores going in gold ETFs after gold has surged 70-80%, 9-10,000 going in silver ETFs after silver has surged over 120%. Nothing against these products. I couldn't agree more with Nimesh. And we'll talk about, of course, ETFs and commodities and precious metals as well as a very important part of the portfolio. But, sir, if I could, take that up with you, and that's where the role of the distributor, the financial planner, comes into sharp questioning again. That in markets which are volatile, probably will be volatile, have we really learned the lessons? Because if investor experience starts, going bad or starts souring, then that kind of sets us back by a couple of steps, doesn't it?
First of all, thank you, Moneycontrol, for giving us a platform. I am from Financial Planning Standards Board, FPSB, and I represent the financial planning community or the profession. And we are deeply linked with the ecosystem, and we play a great role in advising clients in a client-centric manner. So yes, addressing your question, definitely the volatility does give rise to an anxiety with the customer, but that is exactly where the advice comes in. And that is exactly where perhaps a good advisor who is able to influence and who is able to direct the psychology. Who is able to direct the psychology of the investor in the right way and not to worry about a short-term volatility, be it making a fresh investment or be it withdrawing from the existing SIP. He can influence the investor in staying course along this thing. So that is, the investor always gets swayed by the returns which are and as somebody said right now, let us not drive a car with the rear view mirror. So while the actual returns may sway the psychology of a investor, but he should stay on course, with the future in mind and with the way forward in mind.
Mohit, I want your view on this because you spoke about tier 2, tier 3, which is where a lot of your AUM, additional AUM is coming in from. And this whole, return chasing mentality, let's face it, and let's not make any, qualms about it, it's not gone away. People are, when they were fed up of equities not doing well for 1 year and they saw gold, silver doing well, everybody is now moving on gold, silver. So, as an asset manager, how do you deal with a trend like this? A very human trend.
So, what I think I was wanting to address this question that somewhere, what will help is also giving them a perspective of the long term. And I was also emphasized twice that there is a good track record built up. Now, very simple maths is that, in the short term, on a daily basis, it's a toss of a coin, guessing where the market is going to be. But if you look at India, the broader indices, which is a representative of the market movements for the year. So if you look at calendar year returns for the last 25, 27 years, you will find that there will be only about 6-7 instances of markets giving a calendar year negative return. Okay, so what it tells us is that unlike when you play a game, let's say if you're playing a game, this is so heavily loaded in your favor if you're a long-term investor. So the probability of you going right in terms of generating positive returns is 80%. It's superb. People play, such crazy games, but this is about investing money, and this is something that needs to be highlighted in terms of a perspective given to the customer. Second is a very important thing, which again, the previous speakers raised, that anchoring your asset allocation in life cycle goals or life stage goals becomes very important. So when, it's important for the advisor or whoever is the consultant to be sure of, he should be convinced that the market is good for the long term. And then when you point it out and you've anchored the life cycle goals to the asset allocation, you will realize that when the investor sees that this is anchored to maybe my retirement, this is anchored to my child's education, this is anchored to my down payment for my house, redemptions become lesser, relatively lesser. You can't avoid that. So I think giving them a perspective, anchoring it to life cycle goals is important. And the third part for me is that preparing investors for volatility. I think it's an important part. Mostly we all tend to forget that. And the behavioral aspects are sometimes, I would say, overtold but undersold, in the sense that they're not remembered in these times. So to me, all these things, and given, the kind of, I would say, under-penetration we've seen as yet, it's there. I mean, you have to be there when the markets are volatile, and that's the most important thing probably, that, if you, as an advisor or as a manufacturer, if I'm not there for my clients, that could really, spoil that journey.
Okay, so now I want to move to the next part of this conversation, which is the journey, and I'm only taking the MF data, MF AUM as an example of overall financialization. So the journey from, say, 80,000 crores of AUM to 5 lakh crores in terms of AUM. I want to get the panel's view on how this will be covered, given that there are fintechs which will now tell you on your phone which is a good fund, which is a bad fund. Now, whether or how right or wrong those algorithms are, I mean, these are very big questions for us as investors and for this entire distribution community as well. So what kind of disruption is that going to play out? And then you'll probably have these AI agents very soon telling you which fund to buy, which fund not to buy. These large language models, you go on one of these models and say that this fund versus that fund. How is the MF industry preparing for this? And what does it mean for the distribution fraternity? Mr. Singh, you want to start with that?
Sure. Yeah. I think this debate will go on for a very long time, but let me put it very short. understand this. Let it be a support, a tool, instead of saying that this is the only way out, right? So I think it is here to stay. Yes, I get something on the question that you put. Look, maybe, and I'm putting a maybe to this, when I look back, if USA, since you talked about in the last previous conversation also, this was talked about, that maybe USA has more money in mutual funds than they have in fixed deposits. Look, even we would aspire to do that one day. But the thing is, they were doing it when all the technology or AI was not there. So now it is up to us to decide whether we can utilize this to do it faster than what they did, because that time these tools are not available, or we give up and say, look, why do we need to adopt it? So maybe people like at my age, we are trying to accept it and trying to utilize it. The younger generation may not even know what form filling is, because I showed my son what a physical share was, and he was surprised that this thing existed. So I am from an era where we went through a phase of dematerialization, right? And I have my colleague, I think Prabal is sitting there, and we used to work in the same place that time, where we were dematerializing, and we didn't know where the share has gone for months. Now today the life is dematerialization itself. So I think what will happen is as long as we adopt it as a tool, we cannot wish it away. This is going to remain, and the person who cannot adopt it may have to even then try and see alternates, because if any technology, and let me just put a simple example like Uber, Ola, Zomato, Swiggy, Book My Shows, anything. If we are utilizing it for a benefit, why investors will not utilize it? So accepting is better, adopting and upgrading ourselves to utilize it.
That's the point. And for what it's worth, I must share a small personal anecdote just yesterday, and this is on insurance. I was trying to just renew a car insurance policy, and now you have these AI, human type IVRs who are talking to you, and forget about emotional quotient and solving my other longer term issues and all. That IVR failed to understand that I'm in office and I cannot upload certain documents right now. So maybe technology also will have its own, value chain. And I was desperately looking to talk to a human being to tell them that, listen, you issue my policy on such and such day. Anyway, but this is a really important question. And for you, Ms. Chandrakant, for the financial planning community, distributors, IFAs, the disruption is here. All of us as investors will be asking the Googles and the LLMs and the chat GPTs where to invest. How is the distribution community gearing up for it?
Yeah, so distribution community, first of all, obviously has to gear up for this, because AI and all the fintech platforms are here to stay. So they will have to become more intelligent, because now the customer and the investor will approach them pre-armed with the data. So just like, when you approach a doctor and the doctor says that for Google questions, I will charge so much extra. So something like that, when an investor approaches an advisor, then he may be armed with the data, but still if you see any of the websites or any of the platforms, they give you a lot of analysis, but the ultimate decision has to come from a judgment. They will give you the data about past track record, past performance, but as an investor, he needs to see the way forward, because he is investing fresh money. So I feel that the role of advisor as on today is very much there in terms of aligning the goals of the investor with the data, and then arriving at a judgment or a concrete advice, which is client-centric advice. So if you put these three components together, I think the role of investor as on date of the advisor will definitely grow in future. Yes, but he will have to be much more informed and much more having a client-centric approach, as we call it, so that he is able to meet the questions of the investor and meet his goals better.
Absolutely. I think our time is almost up, but two final words, final thoughts with Anuj and with Mohit as well. I go back to my point of the journey towards an AUM of, over 5 lakh crores. How much longer? What about this AI and technology disruption? We didn't get a chance, but there's so many more products coming in the market. There are SIFs. I mean, the passives are growing in a big, big way. So what are we in for, say, over the next, 3 to 4 years? Mohit, and then Anuj, final word with you.
So I'll just keep it very brief that, in terms of AI, I think I would look at it as AI being truly AI augmenting. So instead of the artificial intelligence helping us augment intelligence, I think that's the way we are looking at it. From a manufacturer's perspective, I think we are using it on both sides. It simplifies a lot of things which were generally, required manual intervention. And so in India, I would think that the physical plus digital model, AI is a great way to build it up. So, and if you take example from traditional assets in India, physical assets, what has happened is that it's the touch and feel or the illusion of control that, helps sell gold or precious metals or a house, right? So in the same sense, I would think that a model that would evolve for everyone, whether it's larger platform, smaller, is the offline advice and online transaction capability, which gives that sense of control to the investor also that, there is an instantaneous access to information about your portfolio. You can, buy, sell whenever you want to do. And yet, like he rightly pointed out, that decision making has to be nudged by someone. Typically you see a lot of investors sitting on the wall and they need to be nudged to take a decision and maybe stopping the redemption for that matter. They may want to consult. It's as simple as, if you have all the access to information in AI and if you were to, go in for a surgery or go in for a legal case or invest large amount of money, would you purely rely on that or would you seek some friendly advice? And I think that's the way it should evolve over the next couple of decades.
No, I think that was a very good analogy, and it really hits the nail on the head, because my doctor also says, please don't come becoming a Google doctor. You leave your Google aside and then listen to the advice. And maybe distribution and the financial planning and advisory business has to go the same way. Anuj, final thoughts.
I think it's a complex topic. If you go back the last 20 years, 25 years, it was said that the legal business would be completely disrupted because it was based on old artifacts, old decisions. Anybody could code them. You could create models and all judgments would happen basis that. Has not happened. The same was said about teaching. The same was said about property intermediation. Even today, you and I, when we go and rent a place or buy, I think we have not got rid of intermediaries. There is some element of information processing happening through the platforms. But decision, action, a lot of that is anchored in physical activities even today. And I would argue that I see perhaps another 5 or 10 years of that kind of approach continuing. It is continuing in medicine, although it is said that it's possible for remote agents to give you some degree of diagnosis. But it hasn't really become that popular. And I think whatever my co-panelists have said about having an emotional anchor to take the decision. If information led to decision, then I don't think we would have only 6 crore MF investors. We should have 25 crore because there are so many people who have the information. They haven't taken the decision yet. Having said that, I think AI is real. Against any other automation, one characteristic that we must remember, it is self-learning. It is smarter tomorrow than it is today and than it was yesterday. So the flaws, the faults, the gap, the fissures will continue getting eliminated. The largest amount of money and the best brains in the world are busy creating those models. So kindly don't take them lightly. There will always be a transition period, but I think all of us should be collectively watching about what is to come next.
Okay. Fantastic thoughts, but definitely a lot of optimism about the years ahead for the investor community, for the distribution community, and of course the product manufacturing community. Great conversation. Thank you all so much.
Thank you. Thank you.
Thank you all for reinforcing that transformation is built on consistency, trust, and long-term engagement. And thank you, Surbhi, for driving the conversation ahead. All right, moving on, we now turn our attention to something central to advisory success, and that's the evolution of client relationships. Because distribution today is moving beyond the product execution and towards the relationship stewardship. Investors increasingly expect a trust, personalization, and holistic financial planning that can guide them through different life stages and market cycles. How can advisors move from one-time transactions to building enduring client partnerships? To explore this conversation, please welcome on stage Anisha from Moneycontrol, who will guide this conversation ahead. Joining her are Kaustav Majumdar, partner, Union Financial, and Neeraj H. Sundrani, zonal head, West, UTI Mutual Fund, bringing perspectives from both advisory practice and asset management. Please welcome them with a warm round of applause.
Yeah, sorry. So that is obviously a very interesting discussion that we've had, and a very important discussion that we're talking about. So the mutual fund industry has definitely, grown, transformed over, the past many years. And now for investors, there are many avenues for them to, to invest. There are a lot of DIY avenues, apart from obviously our traditional avenues that are there. So in this environment, the role of distribution has also been kind of evolving. So what we want to look at today is how can this part of the ecosystem build that kind of trust, build that kind of acceptance and interest from investors. So when moving from maybe just a click to a long time, client journey, long time relationship. So perhaps maybe we could just overall start by talking about how client journeys have fundamentally changed over the years. We'll start with.
Thank you. So the question is, how has client journeys fundamentally changed over the years? Frankly, I don't think the client journeys have changed. What has fundamentally changed over the years is instead of a product decision, it has become an identity decision. What do I mean by that? Today, distributors do not anymore think of themselves as mere wealth managers or product distributors. They have started thinking about themselves as the personal CFO or as a finance doctor. So once you start thinking about yourself as a finance doctor or as a personal CFO, that is where really the transformation starts. That is where client continuity starts getting maintained. And that is where clients start trusting you beyond just a mutual fund, PMS, AIF, etc. And they go on to discuss broader things, including estate planning, wills, trust, etc. Because now you are on their side of the table, you are assisting them with a long-term wealth planning approach. So that's really the change that has happened.
Sure, sir. Neeraj, would you?
So I think the client journeys have definitely changed. If you look at the distributors and the clients, say 15, 20 years back, the only thing that clients used to do that time, कि मेरे पास पैसा है, मेरे को लगाने का है, right? From that day till today, if you look at the distributor is not only selling a product, right? Today he is asking about his life journeys, his goals, his aspirations, and therefore accordingly taking him to the financial planning. So today, if you look at the client, does his homework before he comes to the distributor. He looks at the product, he looks at the expense ratios, the returns, and then he talks to the distributor. Therefore, both have evolved a very, very big time. It is becoming more evolved, and therefore, the AUMs are now more sticky. The products take a back seat, but the journey takes the front seat.
Right. But is it more of a sense of, are we still looking at investing from a more aspirational point of view? Is that still the core of how it is? So
it's not 100% there, but let's put it this way. The people sitting in this room, whoever has adopted the life journey, instead of selling the best return product last year to saying, what are you saving for or what are you investing for? Those people, businesses, and those clients' journeys have definitely evolved.
Sure, sure. So I also want to ask you about, we were just talking about AI in the last session. And we have, obviously, various platforms are now available where investors can, at a click of a button, invest. So in this growth, in this, this stage of where we have so much of, AI opportunity and tech that is available, how much of a role does an advisor still play? How important is that advisor's role still in this sense, in this scenario? What's your sense on that? Either.
It's me? Sure. So once again, I would say that this is not a product decision or a product choice. It is more of a conversation decision or a conversation choice. What kind of conversation are you having with the client? We heard from one of the earlier speakers, it is not about KYC, it is about UIC, understanding your client. So clearly, that is not something that the machine can do. We also heard from the previous session, once again, that the moderator was trying to do a car insurance renewal. She was stuck up, desperately wanted to speak to somebody. Our business is that of an emotional connect. It is not a business where you just go, click, get something going, and that's it. So clearly, the transformation begins with that emotional connect that you are setting up with the client.
Sure, sure. So, Anish, if you want to obviously weigh in on that, then. But I also want to understand from you that, we talk a lot about, investor behavior. So how much of this, behavior coaching has now, how important has this become when it comes to, the entire client journey and building that relationship with the client?
So if you look at a very large part of the distributor business today is about behavior, right? ऐसा नहीं है कि technology आज आया है, right? The technology was always there. It was in different forms, say 5 years back or 10 years back, but technology was always there. The technology has taken a separate form today. It is AI today, right? But the distributor who uses AI to become more efficient, right, is becoming a better behavior coach. For example, for those distributors who today behave like an algorithm, meaning for the last 1 year, these are the returns. For the last 5 years, these are the returns, and therefore this should be the product. Versus distributors who say that, what are you saving for, right? Or I sat with that client when he lost his job, in between when he was struggling, and therefore used his emergency fund to fund the 3 months, 5 months. I think these are the instances where you use the AI or any other form of technology to grow scale. And honestly, have all the distributors done it? The answer is no. Are increasing number of people doing it? The answer is yes. And therefore, if you see the last discussion also, the number of SIPs and the number of SIP amount is growing because there are large part of the distributors who have already started working like behavioral coaches to their clients.
Right. But sir, I want to also ask you, I mean, has there been a change in the way now because obviously we're talking about AI and talking about the change in investor behavior. So how has that, changed over the past few years? Because we did have AI, but it wasn't as rampant as it was today. And today's investors are smarter than maybe what they were earlier, smarter in terms of more aware. So how has that changed over the years? And is that making the entire process a bit more challenging? And has that changed the approach?
That's me? Oh, okay, sure. So clearly, I think, yes, definitely AI and all the tools that are available today is influencing investor behavior in a significant manner. However, end of the day, what really matters is the role of a trusted advisor who is bridging the trust gap with that specific client and building a long-term relationship. How do you transform yourself as an advisor? How do you ensure that along with the growth in clients' wealth, you as an advisor, what kind of value addition are you bringing on the table is simply not irrepressible. It cannot be replaced. AI, technology, whatever is there, that personal connect, that value that you as an advisor who has transformed along with the growth of clients' wealth is something that is going to be of permanent value.
Sure. So, Nij, I want to ask you about this, that, a lot of, focus is also on personalization. But when we talk about personalization at a larger scale, how practical is it for distributors?
So if you look at personalization, is a great thing, and in reality, it is difficult to do then we speak about it. How do you use it, and how do you use it at scale? And look at it, personalization is not today, it's been now there for a while, right? And how do you use it? So for example, if the technology or personalization can help me to be there when there are life events, right? When there's a need to. For example, if there is a CRM which tells me that my client's daughter is now ready for, say, marriage or for a higher education, can I be there in the client's house just before it happens, right? Can my CRM tell that out of my 500 clients, these are the 50 clients who will jump like dolphins with the first 10% correction in the market? Can I reach out to them before the market has fallen, not after the market has fallen? That personalization helps, right? But if you use personalization and say that I have some WhatsApp automated tool which sends out birthday message to 600 clients, same font, same flower every time, that doesn't help, right? So can I use technology that can help me to be available? So what I want technology to do for me if I'm a distributor, it should help me trigger moments, and then I use it for being available there. Do I have to do it for all my 600 clients? The answer is no. Sure. Maybe I'll have to do those for those 50 clients who are approaching 55, right, age, and talk to them about what their retirement corpus is. Yeah. Maybe it is for those 50 clients where the daughter or the child is reaching the shadi ka age or the education ka age and be available. So do I have to do everything with everyone? The answer is no. And therefore, personalization at scale is possible. How you use it for your benefit is something that will depend from distributor to distributor.
But when you say it's possible, I mean, how much do we see it actually happening nowadays? I mean, how much do you have in the system?
So if you see, I've been in this industry now for roughly around 24 years. And I've seen the question is not how much is possible. The question is how many are doing it, right? And therefore, distributors who are doing it right, are getting more clients, more sticky money, and they are building it up, right? Is there anybody in this room who's not doing it? The answer is no. Everybody is doing it. Sure. The question is at what scale, right? So there are enough tools today in the market which helps you do it, right? And it is getting better every day.
Mr. Majumdar, could you also weigh in on this?
Sorry?
I would like you to also weigh in on this topic.
Well, I would say, Dheeraj, would you just finish your last piece?
So if you also see with a lot of data, what do you do with data? Data is not new, right? And data does not mean only technology. When 20 years back when we started, there was no, a lot of distributors had all this data in their Excel formats or maybe in physical formats, right? So data was always there. What technology is helping you to do is put them in compartmentalization. So for example, if I am a distributor and I know that I have a client which has got 2 children, their ages are different, I know their goals. So personalization will help only if I am oriented to know how to use data. 20 years back, this was only available to people in segments, right? 20 years back, the distributor had privileges that the client did not have. Yeah. For example, he knew the product, he knew how to access the product, meaning the process of doing the mutual funds and which mutual funds. Today, all that is commodity, right? All products are available on every platform. Knowledge about the product is available. There are YouTube videos, there are Twitter threads, everything is available. And therefore, personalization will happen only when you are keen to understand how to now use the data, right? And that is where I think personalization will help to grow business if you know how to use those data.
Sure. So just 2 things on this. One is predictive analytics, another is prescriptive analytics. So this data is today increasingly being used by advanced technology platforms, and I'm sure many of you are doing that. Simulating that data to come out with some kind of predictive analytics, and using that prediction, you are kind of coming up with a prescription or a prescriptive analytics. So that is what is today really helping distributors to grow instead of just add AUM, multiplying AUM over the years by using data in the right manner.
So, I mean, we don't have too much time, but I quickly ask one last question. So, we're seeing obviously, a lot, as you mentioned, we're using a lot of technology has come into place. So, can technology actually deepen relationships, or does it risk making this relationship more transactional again? How would you sum that up? Both.
Me? Yeah. Okay. So I don't really think technology can deepen a relationship or transform a relationship. So I'll just give a little background. I have worked for several years as a private banker with UBS, the Swiss bank. And there, what I have observed is that the father used to manage the relationship. Today, the son is managing that relationship. And in many cases, the grandson is now managing the relationship. So for years together, some of these wealthy families globally have trusted just one single family as their preferred wealth manager. So clearly, trust is personal, 100%, but continuity is institutional. So once you institutionalize the whole process and ensure this kind of a continuity is maintained, you have a clear succession plan, you have a clear plan to ensure that you are ring-fencing the families that you are managing with not just how much AUM you have, but your kind of wallet share that you have. That is going to be the game changer, and certainly not technology in my mind.
Very interesting.
So, sorry, Dada, I don't agree.
Go ahead.
If you look at, it can help deepen and it can help kill the relationship. See, ultimately, what is our business? हम जितने लोग भी यहाँ बैठे हैं, हमारा business क्या है? Our business is relationship, right? Talking to people, right? If I use the technology the right way, it helps you deepen the relationship. For example, if I know, so आज से 15-20 साल पहले, 25 साल पहले, some of my earlier panelists also said that the only product that was available to be sold was a debt product, right? FDs and PPFs were giving you upwards of 12%, 13% return. So a 50-year-old man or a 5-year-old child had the exposure to the same product. Today, if me and you are of the same age, right, the products for us are different. Now, what tells me which product will you buy or which products will I subscribe to will depend on how will I evaluate risk analysis, how will I evaluate what is my goals, which are the products that are suited to me. Now, if I jump on every 5% correction in the market, maybe I'm not the right candidate for a small cap product, right? Then the best product for me maybe is a hybrid fund, right? But if you are somebody who says, paise bahut hain, there is costed cash flow and I don't worry about what happens to my investments in the next 1 year, 2 year or 3 year because I need the money after 10, 15, 20 years, then a small cap is the only product that I want, right? So technology can help you build relationships because it will help me understand what is it that you will like and therefore continue. Technology will help me kill the product, kill the relationship because if I start sending you 6 a.m. morning messages daily about good morning ma'am, good evening ma'am, thank you ma'am, that is something that will kill the relationship. So it depends on how you use the technology to your advantage or disadvantage.
All about balance. Thank you so much. It was a very interesting discussion. Thank you so much.
Thank
you so much. Thank you.
Quite an interesting conversation about how technology is going to shape the distribution ecosystem. But yes, thank you, Anisha, and thank you, gentlemen, as well. But with that, it's time to take a break for lunch. We'll resume the conversations in an hour or so. So please do join us again shortly. Enjoy the break, and we'll see you back soon. welcome back, and hope you had a hearty lunch. So yes, let's move on the conversation now. We have a next set of discussions. We turn to one of the most pressing challenges which the advisors are facing today, and that's your navigating uncertainty and sustaining investor confidence. Because if you look at the markets right now, they're increasingly being shaped by geopolitical tensions, policy pivots, inflation cycles, and sudden market swings. So in an environment like this, building and maintaining trust in equities and other risk assets becomes quite critical. Because long-term wealth creation is rarely about timing markets. It is about staying invested through cycles. So how can advisors anchor expectations, communicate risk intelligently, and help investors remain disciplined when markets turn uncertain? So to lead this conversation, please welcome Mahalakshmi from Moneycontrol back on the stage, and joining her are Vikas Khemani, founder and CIO, Carnelian Asset Management and Advisors, Vijay Kupa, CEO, Incred Money, and Rajesh Bhatia, CIO, ITI Asset Management. Please welcome them with a huge round of applause.
Thank you so much, Lavisha. So I had a slightly tumultuous conversation with Nimesh in the morning, Nimesh Shah from ICICI in the morning, and we debated a little bit about, what kind of impact this geopolitical uncertainty and where India is right now in terms of, Indian markets are in terms of valuations, our earnings trajectory, and so on. We could only touch upon a few points there. In this conversation, we'll sort of try and bring out, a more concrete and diverse opinion, because I know Vikas Khemani is a big India bull and a market bull, almost at all times. Rajesh Bhatia has run long-short strategies, so he is at times a bull, at times a bear. And Vijay, of course, brings in new perspective because their focus is not only on secondary markets, but in pre-IPO, unlisted space, and all of that, which at least until last year was a big category and big contributors in the markets. So first question, of course, on everybody's mind is, there are two parts to any big uncertainty in the market, especially this kind of geopolitical uncertainty. One is the impact on sentiment, and the other is the real impact in terms of, fundamentally what changes. Therefore, is it a good opportunity if markets sell off? Is it a good opportunity to buy? Or is this something that will linger on for some time? Vikas, your take, your bullish take.
Thank you, Mahalakshmi, first of all, for having me over here, and great to meet all of you. Like I said, like Mahalakshmi was saying, I have been very, very positive, optimistic on India for quite some time, and I continue to believe that. The time horizon can be very different. My time horizons are 5, 10, 15 years, and I think that India has proven time and again over the last 20 years plus, India has delivered 17-18% CAGR return, which is, in my opinion, one or two markets in the world has delivered. So India continues to remain a very, very interesting investable opportunity. The question that, sentiment, this kind of geopolitical situation and sentiment. So first, I want to say that I don't know any period in my career of 25, 30 years when there's no risk, uncertainty around in an investor's mind. कुछ ना कुछ तो चलते ही रहता है. थोड़े टाइम पहले टैरिफ था, उससे पहले पहलगाम था, उससे पहले कुछ US election था, उससे पहले India election था. So कुछ ना कुछ, something is always around, in terms of uncertainty. My take on, risk is that risk always comes from the sources you don't expect, and it comes from, when you don't expect. So you have to be prepared from a risk perspective कि ये आ सकता है कभी भी, right? And the best time, from an investor perspective, as an investor, I like is when fundamentals are better and sentiments are poor, because you can't get good price and good news together. Good price and good news together cannot happen. वो अलग हो ही नहीं सकता है. तो and as an investor, ये बहुत common sensical fundamental चीज है कि अगर कोई asset मेरे को खरीदनी है तो वो सस्ती खरीदूंगा कोई भी कारण से तो better है, right? As long as I like the asset, right? So जब भी, there's a bad news for whatever reason, and impacts the sentiment, that is a good thing. But now coming to the current geopolitical situation, of course, you know, we know all things are going on. I think as far as India is concerned, the big impact is expected only in form of oil. Now that really depends on how this war lasts. But the good news to understand is that assuming that this can last 3, 4, 5 months, the impact on the Indian economy will only be 3, 4, 5 months, right? And in equity investing, the large part of people who track fundamentals, large part of any stock price is determined because of terminal value, long-term terminal value of any business. That doesn't change because of a short-term news flow, right? So at best, this short-term news flow can create dent of 5%, 7% kind of stuff, which I think, you know, partly it has already created, partly might come, who knows, and who cares? According to me, people who look for, you know, 3 to 5 years perspective, and go back to your memory, 2020 was a very similar environment. 21 was a great year. Everybody was bullish. You know, 22 started on a great note and the Ukraine war happened. And next 3, 4, 5 months sentiments were kind of very poor, very similar to current sentiment. And then September onwards, I remember writing a note that time, build this vintage. This will sort of come back, you know, this will be a very great thing. Because that time price and sentiments were very different. And market started recovering without any news. Ukraine war continued, but market recovered. 23 turned out to be a good year, right? So India fundamentally is very solid. India's economy is very solid. Macros are very good. Our debt to equity, debt to GDP ratio, our banking system is good. Inflation is under control. Our fiscal deficit is under control. Our current account deficit is under control. So currently, there's not, and corporate earning is recovering. We are sitting on a big stimulus, fiscal stimulus and monetary stimulus. So fundamentally, economy is chugging along very well. And this has given you a great opportunity to kind of get good prices. So that's the reason I feel build this vintage. This vintage will again help.
Sure. So Rajesh, are you a bull or bear in this market? While all of this that Vikas mentioned is true, that, you know, India's macros are great, we are fundamentally strong, our banking is cleaner than ever before. While all of these things are true, you know, valuations of course have come off from the peak, but still not aligned to the long-term averages, slightly higher, probably somewhere close to long-term averages. And this is a question I asked in the first session also. As we know about markets, while they tend to overshoot on the upside, they can also overshoot on the downside. Considering the environment today, how do you see?
You know, as you started with the expression that volatility is really more than the reality. And I think I agree with Vikas that the long-term trajectory of India is really on solid grounds. I won't dwell too much into that, but look at 45 years of performance of the Indian equity markets and the structure of the macros, balance sheets, etc. And you'll be convinced that the inward-looking, consumption-driven economy will bounce back and it'll be earnings-led. But let me give a nuance to this because as a long-short manager, that perspective is equally important. See, to some extent, you know, I've been cognizant of the fact that there is passive money that is chasing Indian equities. Mutual funds sahi hai, I'm part of the mutual fund as well. And that is true, mutual funds sahi hai, because India has been a fantastic story for 45 years. But that has definitely led to pockets of overvaluation, particularly in the mid-cap and small-cap space. I would say large caps have come to more reasonable levels, but definitely there is a degree of overvaluation. And to that extent, relatively to the globe, given the AI story or even the commodity story, we are not participants in that. So to that extent, the foreign interest in our markets is certainly a little lower. And that is compounded by the fact that we are not necessarily a cheaper market. So that is a struggle that we are going through. And then it brings us to the current context of the geopolitical challenges, right? So we also have to contend with that. And oil, we import about $150 billion of oil. I think if this war is prolonged, it does impact our macro. When do large corrections in India happen? If you look at the history, large corrections in Indian equity markets always happen when there is a macro imbalance. And there is a probability of that at this moment. So as a long-short manager, on balance, yes, the long-term trajectory of India is fantastic. There's great reason to believe that India is going to be a fantastic market as you move forward. But in the shorter term, there are some challenges that we have to contend with because the geopolitical, if oil does go to $100 or $120, then it can definitely impact our current account by a very large margin. Definitely the balance of payments, definitely the rupee, definitely the fiscal, definitely inflation. So there are just so many variables which is equals to macroeconomic imbalance. And that is where large corrections in India have usually taken place. So I'd be a little more patient before putting in fresh money, evaluate the opportunity. It's not as if we are significantly cheap, that you don't have to worry about timing the market. We are still at a slightly elevated level, so be a little more patient.
Vijay, largely you have products in the unlisted pre-IPO space. And a lot of activity, of course, IPO activity happened last year. And even more in the unlisted space because people are wanting a little bit before the IPO so that they can make a killing, which was anything but true last year because a lot of IPO pricing was actually below the unlisted market prices. How do you see activity in that space? And do you see a lot of, correction happening because are they in sync with what the secondary market is reflecting today? And do you see them at levels which are still not embracing the prevalent risk?
Hi, thank you Mahalakshmi for having me. So we run a platform where we list a lot of these alternate products and one of them being pre-IPO unlisted shares. So the first question was how the market is doing today. I think we are also as equally affected like the listed space. In fact, our products are a lot more riskier and the appetite for it is, you need to be a lot more risk appetite to adopt to those products. So of course, we are doing pretty badly as a business right now. But yeah, I think it's part of the course. It's very closely linked to the equity market. Regarding the specific question around IPO pricing and pre-IPO pricing, I think what we are seeing is that usually in any product, as the gentleman here said, that we tend to go over when things are good and then we tend to go the other way when things are bad. So when there is what I call like a FOMO trade, when there is a lot of momentum, in fact, retail should always be counter-cyclic. But it so happens on the platform that whenever there is a trend is when everybody piles onto the story. The case in point being recently on gold and silver investments. I'm sure all of you have your own customers. How much ever you tell them about portfolio diversification, how much you tell them to, invest at the right prices. When they want to do it, when they have the momentum for it, they just go for it. Pretty much no one looks at the end of the year, the P&L and says, oh, you know what, I made so much money. That really doesn't matter at that time. So I think any product, and pre-IPO is no exception, you need to come in at the right price and you need to come in into the right stocks. Now, because this is, not so regulated like the listed space, you have many players who operate in this market. As a result of which that, sometimes the prices are not very transparent. And when such a momentum comes in, like for example, it happens in NSE is a very popular example and so on, then you get a lot of buying happening at, very high prices, which then doesn't reflect the profitability when the company actually lists. So last year we had a lot of IPOs and yes, many were, not really great for the customers who bought them. However, now we are seeing the opposite trend. Now the IPOs are reducing, so there is less demand for that product. And in fact, we are seeing more rationality in the prices now. So I feel for retail and all those who are serving them, best part is to be counter-cyclical and invest when no one is really looking because that's when you get the best price.
Sure. Because you said you're bullish, is it possible for you to build out, best case, worst case scenario for this year? Based on, how things could pan out from here on. I mean, especially considering the geopolitical situation. And we're all hoping, and there are a whole bunch of analysts also who say that, oil price spike should be capped because the supply situation is not so bad. What would be your best case, worst case scenario for this year?
So I think if, let's say, assuming the war settles down, in next 1 month or so, and we get back to normalcy, I think we should, in my opinion, given the trajectory of the Nifty earning, and market earning, last 2 quarter earnings have kind of really picked up, and I see a good momentum. Consumption has picked up, investment cycle is doing well, bank credit has picked up very well, commercial vehicle growth is there, insurance premium growth is there. So I'm saying generally the trends are quite positive from a fundamental economic growth perspective. GDP growth is good, inflation is controlled, GST tax collection is good. So I'm saying all indicators are in a positive direction. We should, in my opinion, assuming all these things settles down, this financial year we can, hit 29,000-30,000 kind of Nifty. 15 to 20% kind of return is possible in between that range. Because earnings should, in my opinion, this year would be about 14-15%. More importantly, when the traction continues, you guys can see fund flow from abroad also coming down. So far last year, India was consensus short trade from a FI perspective. That is beginning to change. At a margin, still not fully changed, but that's beginning to change. And this only has kind of little bit put it on hold. So I think that's the one probably positive side. Negative side, I do believe that if this gets prolonged, and that could be, anybody's guess how long it get prolonged. I would worry more about if it can build into a little bigger conflict, in the sense, can Russia, China get involved, which does not look like at this point in time from any side. But let's say assuming this continues and the oil supply remains blocked, and oil price goes to $100 or something, let's say about that, that's the scenario where we'll have to think inflation goes up, especially supply chain gets disrupted, corporate profits get compromised, especially in some segments. So we can, I wouldn't, in that situation also, I wouldn't think that corporate earnings will collapse and hence market will collapse. There could be the growth of 15%, may not be growth of 15%, might be growth of 5-7%. In that sense, probably you will see maybe 5-7% correction more rather than, we already seen few corrections. So, that's the kind of, the reason why I'm kind of more optimist on this is because the risk reward, downside is limited, upside is positive. Now, I'm not taking into account any unexpected event happening, because that you can never, I always believe the risk comes from sources which you don't expect. Tomorrow, if there's a biological war or cyber war, something happens, who knows? What are the implications, right? I have no idea. So I'm saying...
So as of now, you're saying 5 to 7% downside in whatever scenario plays out.
Yes, that's what...
Realistically.
Realistically.
Rajesh, you said, in certain pockets, you still are not comfortable with valuations. How much more downside will make you comfortable about starting to buy?
See, I focus on what I can control, right? So what I can control is how do I make a buying decision, right? And there is a certain absoluteness in terms of what is attractive, right? So there are some pockets which, of course, let's say are correcting. You've seen, pockets of real estate correcting very sharply, EMS companies correcting sharply, specialty chemicals correcting. So, what we do is that we look at these pockets and then we say which are the ones. We are not necessarily buying the market, but when we are making those buy decisions, we are looking at, okay, has this come to a valuation that makes sense for me to make an absolute decision on the investment. So that is how our process works on, how we kind of see the investment opportunity.
Understood. Vijay, I know your platform is not really into advisory services, right? But where do you see, one of the big things that sort of, I don't know if I should say alarmed, but was a big surprise for everyone in the mutual fund ecosystem was how much retail investors really chased gold and silver, like especially gold ETFs, right? So do you see that kind of behavior perpetuating, or do you look at it as something temporary which, will change with performance, because that money also chased performance?
Yeah, so I think it just chases performance. We have seen that when the equity market gives a bull run, we see the same kind of frenzy towards equity investments. Gold and silver did it now, so we saw it over there. It also coincides with the period that last 1 year hasn't been good for Indian equities. So people have not been making returns. So they are actually trying to find where can they find the next pocket. And gold, fundamentally, they always have it in physical form, which is there in most of the households. Because they saw that wealth effect coming in and they realized that, okay, their call went right by holding on to so much gold, they started chasing more and more of it. So in fact, we kind of published a report on our platform when volume spiked, and volumes actually spiked with the highest prices. So that day was there. it's not a surprise, but that's how that behavior is. So I think right now, for example, because again of the geopolitical tension, gold is again starting to go up, and we are seeing demand in it. Silver is a little different. Silver was a little FOMO story, but there is also a supply-demand gap over there. There is real industrial demand for that metal. So I think as long as geopolitics is going to take center stage, assets which are more risk-off like gold or debt or bonds, we are seeing that frenzy. In fact, in bonds and deposits, we are seeing a lot of activity right now, and less so much in equity. So I think whichever does well, investors tend to chase that, and it's just human psyche. So I don't think that's going to change. All you can suggest to your customers is that do it proportionately so that you're not over-invested in any one asset class, because what's hot today will not be hot few months down the line. So for now, maybe yes, you can add up gold and commodities, but you can also add debt. In fact, debt is not recognized much in general. It's only during tough times that people think about debt, which they should have from a portfolio point of view. So fine, I mean, if FOMO is making them chase debt, then so be it. I'm sure equity will also turn around at some time and people will go into that asset class.
Interesting. Because this room is full of, wealth advisors and mutual fund distributors. And one of the challenges that everyone faces is when markets go down, clients are hopping mad. What is it that you think client-facing people can really tell investors at this point in time? Is it about waiting? Is it about continuing with the SIPs, which generally tends to be our evergreen advice? If you have excess cash, sit on the side with dry powder, keep it in debt funds or liquid funds, and then look out for market correction to buy. What would you say that generally it's a good thing to say to clients at this stage?
I'm sure all of them are fairly qualified to give advice to their clients, but and I understand their job is very difficult, because I think I always say most wealth advisors, managers' job is to actually manage the psychology of the client, because when the markets are doing very well, clients want to put money even if the advisor is not advising, then he will pushing you to put money. And today, selling a gold fund is far more easier than selling an equity fund. So unfortunately, this because of the behavioral bias called recency bias. Our human minds are biased like that, saying that whatever has happened in the recent past will happen. That's the most comforting, and that's the reason if you see, nobody wants to believe equity right now, even if the risk reward of investing into equity is right now there. And risk reward of investing into gold is probably not there, but people would be very easy to allocate money on that, right? So, and I always say that the real job of a good advisor is to tell client what is right for him. At times, it may not be the comfortable thing, but it's the right thing for him. But now it depends on what is your relationship with the client, whether he's ready to listen to you or not, because the temptation is always between sell and not sell, right? Le raha bech do, nikal gaya. But I think if you see long-term perspective, if anybody wants to, and I have always believed that people who give right advice, over a long term, they turn out to be far more successful, because the client will also tend to appreciate that this guy has ability, guts to tell me what is right and wrong, rather than just, advising me based on what is current and trend and all those things. It's always easy to, see in the rear view mirror and then advise, but actual real, this thing is, through the windshield, look ahead and say what can possibly happen. Does not mean that what we think today will happen, but at least our job is to kind of educate, because see, unfortunately in India, and not only India, globally actually, financial literacy is very poor. If I am an engineer, I am working in a corporate, or I am doing my business, most people are not financially literate, right? They don't understand. And I can tell you, most investors don't know how to see IRR. मैंने 10 लाख रुपया लगाया था, 20 हो गया, वो कितने साल में हो गया, उससे कुछ फर्क नहीं पड़ता, right? So I think job of a wealth manager or advisor is a very, very responsible job. So educate client, manage their emotion. It is a difficult job also. Yeah. It looks very easy, but it's not easy. It's a very difficult job. So I would say take long-term view, advise right. What is risk reward is always, you can't get price and emotion, price and sentiments both together. Either you'll get poor sentiment or a good price, or you'll get bad price and good sentiment. So choose between whatever you want to see.
Right. Rajesh, from a mutual fund category perspective, what would you say will be like a wise choice. I was looking for this term. I mean, should I say safe choice, then that'll mean something. But what is a wise choice for this year?
Yeah.
Because we also had the SIF, which is a new product. Yeah. And a lot of people will be familiar with it, may not be comfortable yet selling it to clients. Yeah. Yeah. In your view, what is a wise product for these times?
Yeah. So first of all, I think I totally agree with Vikas, whatever he has said in terms of the job of a, wealth manager, which is really managing the emotional volatility of a customer. And there I would just like to point out the asset allocation. What I have noticed is done after the event rather than prior to the event. So like he pointed out, gold, people want to invest gold after the stock, gold has gone up, and vice versa. So I think, one lesson that I think I see repeatedly where people make mistakes is asset allocation is a priori, not post the event. So if, I don't want to elaborate on that, but that's something that I've seen as a mistake that people continue to make over and over again. You're absolutely right. I think the SIF is really going to be the product of the year. I think given the one-sidedness of the Indian markets, which is a long-only market, right? And as I'm pointing out, the passive money that keeps going into Indian equity has made Indian equities a little more vulnerable to any macroeconomic shock. So not only is your valuation high, but, and high. I wouldn't say that it's extremely high because the fact is that we've had a correction for about 18 odd months. So we have definitely had a time-wise and a price-wise kind of a correction. But having said that, we don't have anything in the portfolio of any investor which can defend a downfall in your core portfolio.
Right.
So there is a need for a long-short fund manager or a asset allocation where the SIF, what it does, the SIF long-short equity does is, in case the markets go down, it'll protect your downside, not capital. Protect your downside. And equally, if the market goes up, you will participate. So given what I am seeing today in terms of geopolitical risk, etc., and yet all of the points that Vikas mentioned that, look, India is in a much, much better position today. So if this war gets over, things will come back very quickly for us, and given the 18-month correction that has taken place. But what if it does not? So you still have those two outcomes. How do you protect against both those outcomes? Right. The answer is a long-short equity fund. And the SIF is an excellent platform which democratizes this. So to answer your question in a single line, which is the product that I think for the year or even for the next 5 years, I think it's a fantastic asset allocation that you take out of the asset allocation itself. Because if I'm protecting your downside and making you an equity return, you don't have to take a judgment of whether I need this product at any point of time. Unlike an allocation to gold or an equity or so on and so forth. So you just take that product allocation out of your asset allocation dynamic.
Right, right. No, I think the only mistake a lot of people I meet make is to think that long-short fund essentially means that you will make loads of money when the markets go up, and you will also have equal opportunity to make money when the market goes down. That is not true.
No, absolutely. So at ITI, what we have done is that in the AIF format, we have demonstrated 8 years of history. We have said that once we build a history, people will know what to expect.
Right, right.
So we have set up the expectation. Look at our history. That tells you what to expect from a long-short equity fund. So,
Yeah. Vijay, I know you are not into advisory, but and as an entrepreneur who's building out a business, all your money must be going into building your business. But personally, with all your financial wisdom, where would you put money for this year, and what would your advice to be for friends and family who are looking to you for advice?
Yeah, so
long-short fund.
Suzy, we always talk about diversification. I think no better time than now to hold that up. In fact, it's not just diversification of client portfolio. I also think as an entrepreneur, business diversification is also very important. we talk about all-weather funds for clients, right? But it should also be all-weather business. So the way that I've tried to build up Incred Money is that we have alternates across equity, debt, commodity, and whichever is working well, typically business tends to do well in that direction. So, I mean, for example, a new product that we're coming out with is global investing. When you look at how markets abroad are doing, they had a phenomenal run versus India over the last 12 months. So this kind of shows that you have to diversify. You don't know where the next risk is going to come. Be well prepared across, cover all your bases. So even when I look at my personal portfolio, I just try to diversify across all because there'll be some times when some products work, some investments tend to do very well, and in some markets they're not. Like equity in the last 12 months hasn't done well, but my debt investments have done well, gold has done well. Now I'm personally not happy when I look at it. I think I'm underinvested in gold when I look at the overall portfolio. But the problem is that if you ask me today, can I buy gold now? It's very hard. It's really very hard to buy it at these prices because then your logic kicks in and you say that, I can't do it. So when things are not in flavor, for example, equity today, probably it's a good time to start buying that to build your diversification hedge. Buying at 30,000 may not be the right thing. You should do it when, things are off. So we tell all our clients that buy those, products which are not in flavor. But of course, we are not in advisory. We more offer it like a platform. And it's just that some things tend to do well in some times.
Absolutely. Very, very well said. Because when things are a little ambiguous and not absolutely certain in one direction, then it's better to place your bets across the board. But thank you so much, gentlemen. Very enlightening discussion indeed. Thank you so much.
Thank you.
Thank you.
All right, thank you, gentlemen, for sharing those valuable insights on navigating volatility while sustaining long-term investor confidence. And thanks, ML, for driving the conversation ahead also. But yes, let's move on and take in to the next conversation. Given that as geopolitical tensions have been rising, central banks continue strong gold accumulation, and precious metals have re-emerged as a critical allocation discussion. Gold remains a traditional hedge, while silver's industrial demand is also strengthening with global energy transition themes. So are metals the tactical shock absorbers or structural portfolio components? Please welcome Surbhi Upadhyay from Moneycontrol to lead the conversation. And joining her on stage is Vandana Trivedi, Head Institutional Business and Passives, Axis AMC. Anil Gilani, CFA, Head Passive Investments and Products, DSP Mutual Fund. Amit Vashisht, Head Passive and Fintech Business, UTI AMC. And Kaustav Belapurkar, Director, Fund Research, Morningstar Investment Advisor India. Give them a huge round of applause.
Good afternoon, ladies and gentlemen. So I think I have the good fortune of having probably one of the most interesting panels of the day. This is all anyone's talking about. This is all what anyone wants to know, right? So our discussion is precious metals as a strategic asset class. Ladies and gentlemen, I don't know about strategic. It's definitely the biggest FOMO asset class, perhaps, of 2026 for sure. So there's a lot to discuss, and I think we need to talk about the role of passives and ETFs because finally they seem to be coming of age. Investors have voted with with hard cash, hard money in the month of January. And it's been quite staggering, even for financial market watchers or personal finance watchers like myself, to suddenly see this huge interest in these products, which were otherwise till now kind of at the periphery, at the margin. So let's start by first understanding what's gone on, what's kind of happening here. So let me start with the lady. Vandana, your thoughts on this, just that number, 24,000 crores in gold ETFs, 9 to 10,000 crores in silver ETFs. I don't know what the numbers of this month, the latest month, will look like. But what comes to mind when you saw that frenzy play out?
Yeah, thank you, Surbhi, and welcome, and thank you all for participating in this panel. So what's been happening, Surbhi, is it's essentially, if you want to go back a little and also taking a cue from the previous panel, there has been a sense of a couple of biases. One is a recency bias with respect to gold as an asset class. There is a FOMO bias, like someone mentioned, right? You're watching gold move up and everyone is buying and you haven't bought, and that's where the chase has come, in my opinion. But importantly, there are also a couple of very important two more biases. One is, if I may be permitted to call it the narrative bias, right? Essentially what's happening is that there is a lot of conversation about central banks buying gold. Therefore, a lot of institutional intelligent money is chasing gold. There is a lot of conversation about geopolitical tensions. So that's also building into this frenzy to chase gold. And also for the Indian investor, like Vijay before me was mentioning, essentially we are a gold, physical gold holding investor, or rather citizenry, right? Now we have discovered in ETFs a liquid version of holding gold. So the convenience bias is also coming, and I think all of these biases have actually helped gold demand or appetite amongst investors. But just because there are a lot of advisors and distributors here, I really think that, you know, if we were to track, say, 2024, it was the year of sectoral or thematic funds, right? There was such a frenzy for those funds. 2025 has been gold, silver, precious metals, and what appears like an asset allocation bias emerging in investors, I'm not sure if it indeed has. So I guess it's investor behavior which is driving all of this, aided sufficiently by narrative. Last point on this, I'm not completely writing off the narrative. There seems to be a structural change underway, probably, which probably started with the Russia-Ukraine war in 22, and therefore genuine central bank buying. So you cannot wish away the geopolitical changes that are happening, and these may be happening for good. So there is some credence to pencil in. I'll stop there.
Maybe I'll add one more point. The fact that the government of India stopped issuing sovereign gold bonds.
Yeah,
that kind of became a kicker as well.
That too,
right?
absolutely right. Yeah.
Anil, you want to add to what Vandana has been saying?
Structurally, I think it's a very good point, and how you articulated that since the 2022 war, people thought that there is a structural shift. Now, my point is that when that started, people were thinking that it's a small thing, in a couple of weeks or a month or two, it will even out. But I think it's very unfortunate that we are still as a part of it. So I feel as long as these two big wars are going on, one is a physical war amongst few countries. Nobody wants that war, but it's going on. And the second is the war of the uncertainty around the tariffs. So wherever there is any uncertainty, as well as this kind of unfortunate war situation, we will still see a flight to safety and a safe haven type of a demand. Now, whether central banks are continuing to buy or not, that nobody knows. Unfortunately or fortunately, central banks are not like us as an ETF manager or a mutual fund manager regulated by a SEBI, that every month they have to disclose actual and factual data. But based on some information, some central banks are proactive, they are sharing what they are purchasing or selling. On that basis, we have started forming an opinion how much they are buying, which is a good thing. Now, whether it will continue, that's the main thing which we need to ask. Now, I feel traditional thinking that gold is safe haven, it will hold value in times of uncertainty, that does play, but in certain very stressful situations, it might not hold true, because at that point of time, whoever is the investor, they will want to book some gains and exit that asset class, whether it is gold or equity or fixed income, anything. So I think sitting today, all of us, when we are talking to our clients to put in their hard-earned money, we need to be very clear about this aspect in mind and try to advise them.
Absolutely. And that probably is one reason why in the last 5 days, now that we have a full-fledged war in West Asia, despite that, we've not seen a massive surge, because there is that element of people booking profits while there are, people taking fresh exposure given the continuing uncertainty. Amit, weigh in on this. When we talk about a stock, for instance, when there's always a concept of the intrinsic value of a company or the underlying security. But is it much harder in the case of gold and silver? Because there are too many X factors at play. Risk of, value of the dollar, its position vis-a-vis other asset classes. So for someone who's trying to kind of stay away from FOMO, for that investor, how does he or she look at intrinsic value, fair value versus the market value, and how much, that we talk about reversion to mean, right, in equities. So I don't know if that concept works in the precious metal space.
So you rightly highlighted, whenever we discuss about stocks, whether Infosys is overvalued, whether TCS is overvalued or Maruti is overvalued, we can do the parameters through PE, PB, multiple ratios. But when we talk about commodity, we should understand we should not track basically on the only simple parameters, because these commodities are driven by multiple things, like Anil clearly highlighted geopolitical tensions, which we have seen what's happening in last 2-3 years. Vandana clearly highlighted that central banks are buying gold. So when we see the movement in gold and silver, we should keep one thing in mind. Sometimes for decades, there is no movement. And sometimes within months, everything comes out. So that's we have seen multiple times in gold and silver. This is not the first time. We have seen times when gold have given a negative return of absolute 40 to 50% for continuously 22 years. So this as an asset class is more volatile than an equity. So that's one thing we should keep in mind when we're thinking gold and silver. It looks like a safe haven, but in real terms, there's a huge volatility underlying in gold and silver. Currently, again, it's very easy to say that gold and silver have moved 3-4 times in last 2 years, but we have to understand what's underlying. In gold, it's clearly visible, geopolitical tension, clearly visible. There is a low trust on dollar. So people are looking an alternative against dollar. So generally in these periods, we go to the safe products like gold. Silver, although we are discussing about that it is in line with gold because of a safe haven, but we also have to understand that what happened in last 15 years. That silver industrial demand increased multiple times. From last 3-4 years, it was clearly visible that silver is deficit in terms of demand. It is just that it started moving in last 1.5 years. And we as an investor generally go to the asset class once it's moved more than 100%. We have seen in COVID, we have seen in 6, 7, 8. Vandana clearly highlighted about the sector in 2023-24. So as a retail investor, always goes when we see a returns. So my only suggestion is stick to asset allocation. That is the best way to be invested in commodity.
Absolutely. Kaustubh and I, over the years, have discussed so much in mutual funds, sectoral funds, equity, all kinds of things, new products. But Kaustubh, I never thought I'll discuss with you. I mean, 100% plus rise in 1 year in a precious metal like silver, right? What have you made of the investor frenzy, the FOMO, the fact that equities aren't working? So you think this may, and it may just, who knows, it may shoot up another 20-25%. So as investors and as people who are distributing these products, what should we keep in mind?
So like you said, we've spoken about this for several other asset classes, and I think the same thing kind of playing out in commodities and gold, and it doesn't surprise me. I mean, it's been sort of investor psyche that we've spoken about, the behavioral biases that Vandana, Anil referred to, in the sense that, when you've seen that kind of stupendous return over a period of time, that, that backward-looking bias, looking at past returns and investing. So, I mean, I looked at the January numbers and I was astounded. 24,000 crores in gold ETFs. The entire 2025 probably saw about 40,000 crores in gold ETFs, right? So in 1 month, you've almost covered like 60% of that number, and perhaps I don't know how much more is going to flow in, given a little bit of correction that you saw towards the end of, the month of January. So February numbers might again surprise us. So I think a couple of things, right? So, and let me share one interesting anecdote from a conversation that I had very recently. So I was in the month of January, in the end, right towards when gold prices and silver prices being very volatile, I was on a trek in Africa, okay? And one of my fellow trekkers was this very senior guy in a global commodities firm, right? An agri-commodities firm in the finance department, probably has a good pulse of...
Sorry, Kaustubh, I'm just being told if you could just hold the mic
sure.
with the hand down a little bit, because the hand is covering.
Okay, my bad. Yeah, so a very senior guy in the finance department of a global agri-commodities firm. And we're tracking up this fairly high peak. We're at like 19,000 feet and struggling for air. Like, okay, let's get some more oxygen. And he's trying to find a network. I was like, why are you doing that? He's like, no, I'm just trying to check the gold price of where it's gone, right? So that's investor psyche, and it happens to the best of us, right? So the point that I'm trying to make is that gold has obviously seen, for the reasons that were very well articulated by my fellow panelists, in terms of geopolitical tensions, US dollar weakness and all of that. But there is, in a sense, no fundamental value, to your previous question. There's no way to fundamentally value gold, right? It's all about supply and demand. We all know about central bank buying that's happened, not just in India, but you see the kind of flows that you've seen in gold ETFs in Europe, in the US, in Asia. The largest gold ETF is, I think, about $175 billion now, the Spider gold, which is massive, right? And that's the kind of flows we've been seeing over the past year or so coming into some of these. So that's what's been happening in terms of investor sentiment. I think what we need to think as investors is, where are our expectations being set, right? Are we coming with misplaced expectations in terms of what's going to happen with gold, right? Because no one knows where gold can move. And secondly, are we over-allocating in our portfolios, right? I think that's something that we as advisors in the room need to think about and have that conversation with investors, that how do we fit these in a prudent manner in our portfolios. I think that's the conversation that needs to be done.
Let me do a snap poll on this panel. Asset allocation, how much to precious metals? How much would you give, Vandana?
Oh, yeah, I caught the SGB rally well. So I participated in each of it. I'm pretty much out of gold ETFs other than the skin in the game, which is required mandatorily. Okay. So must be about 10%.
10% of portfolio.
Yeah.
Anil, for you, friends and family, what's the right proportion?
It's very difficult to come up with the right proportion, but just to share it on the lighter side, because this is just after the lunch session. During the lunch, there was a very nice dessert counter which had some ice cream and some gulab jamun. And suddenly there was a feeling that that ice cream is very tasty. So in some time that sort of news spread, and suddenly that guy said, sir, this ice cream is over now, counter is shut. Because there is no that ice cream is over. Now, thinking about that, the people who went for lunch later on, they can't just stock up on dessert as a particular item and leave out the rest of the lunch, because then it won't be a balanced meal. You won't be able to sit in the room later on. So likewise for us,
I know a couple of people who are planning to skip lunch and only have the ice cream.
Absolutely, Surabhi.
So we can't do that, right? With investments or with our lunch.
We just cannot do. Some of us who have Gujarati blood, who have little bit sweet tooth, they can still manage for a couple of hours, but not beyond that. You will need your carbohydrates and your protein, etc. So I feel, and to my specific thing, I have approximately 8%, which is in commodities as an asset class. Some part of it ran up because of the mark-to-market in these last 12 to 18 months. So that has skewed my asset allocation a little bit. But I'm comfortable with that. Not anymore. Very often people tell me, "Arey Anil bhai, aap khud itna bada gold ETF chalate ho, itna bada silver ETF chalate ho, aapne itna hi kyun liya hai? Why don't you add?" Because if you are having a positive view, come and talk to our clients to buy silver because of, like we spoke about, some demand-supply mismatch, or you spoke about gold because of uncertainty. I said, no, but still, it has to be my dessert and not my only meal. So I think 8%, 10%, depending on each of your investors or your own hard-earned money's risk appetite, should be a good number.
Amit, same question to you. And let me add an anecdote. Over like last 10, 15 years of hosting personal finance conversations, there was a point in time where a lot of advisors would come on television, on shows, and say that, look, Indian households are anyway overexposed to gold. So don't bother. Go full throttle equities. But this is like 10 years back. But now to Vandana's point, that a lot of, perhaps that sentiment is changing, that gold jewelry and that har dhanteras pe gold coin lena hai. Indians will still probably do that. Plus there is gold ETFs or sovereign gold bonds. So are we over-indexing ourselves because of this slight FOMO?
So I was just waiting for answer the same question you asked last to the panelist. But thank you for asking the similar question. So in my experience, I bought gold ETF and it was almost 3-4%. Currently, because of mark-to-market, is close to 7-8%. But last month I was talking to my mom, so she told me, your dad used to buy gold coin on every anniversary. Definitely buy on Dhanteras. Then I got into a shock and asked how much the gold is. So when she told me in grams, then I realized my family gold allocation is now increased to 20%. So you are rightly highlighted that in India, it's a culture, whether it's a Dhanteras, any occasion, But gold was a disciplined investment from last 100 of years. So that we are following, and that's why our history have shown that these kind of turbulence keep on coming in. That's why I felt that gold is an asset class people keep on buying. And I still feel the generation of ours are not overboard on gold. We might say people of our parents and others might have holding gold, physical hold, but our generation, our typical majority, either in equity, stocks, mutual fund, to an extent, FDs. Gold has just started in last 1.5 years. That's what I feel. And I think ETF is the best way for this generation to invest into, because they no more attach themselves with the typical physical gold which our parents used to. So I think young generation should continue doing either through multi-asset or through ETFs, but they should keep a part of their portfolio in gold.
Now I want to talk about the product itself, ETFs. It's gold ETFs, silver ETFs, because it's still new for investors to understand. And I think that is where confusion is happening, because, and I have done some conversations and shows on this, especially when there was volatility that hit the product in January, right? And then even till today, people keep writing saying, why are suddenly ETFs opening down 5, 6, 7%? We haven't seen that move in international gold prices. So let's take that up, and what you would like to say to the distributor community. A lot of these products are maybe not even going through the distribution channels. They are DIY products, you just click and buy. But I'm not sure if enough awareness has spread on what is causing this volatility, the fact that these are ETFs. The regulator has already come in to put a tighter circuit, 6% circuit. So just let's highlight the volatility aspect and the regulatory aspect that's trying to sort of keep pace with it, including how gold is being valued, which is now, I think, on the spot basis. Who wants to take that up? Kaustav, you want to start there?
Yeah. So I think, Surbhi, you're right. I mean, and maybe I'll just, before I jump to that, I just want to add a little bit to the gold allocation part, because we actually did a very interesting study across Asia, including India, looking at, what's a traditional asset allocation for, say, a long-term investor who's got like a 15, 20-year horizon. And what that told us was pretty much in sync with what my fellow panelists shared, that if you allocate up to about 10% in gold, if you had a 75-25 traditional equity and fixed income portfolio, you add about 10% of gold. And what's important is where do you finance that 10% from, right? So you take it from equity rather than fixed income, actually improves your overall risk-adjusted returns. Obviously, over a long-term, 20-year horizon, that's what our study showed us, that's probably the optimum allocation that you should be looking to have in that sort of the traditional equity fixed income portfolio. But to your question, I think that's a very important conversation to have, because a lot of times investors, DIY, are looking to buy ETFs, and sometimes you find these misplaced sort of trading prices that are on that particular ETF where the underlying, the INAV could actually be. So I think that's something which is very, very important for investors to also consider, because when you think about evaluating ETFs, be it gold or any other ETF, it's not just the cost, which is the expense, but also the trading cost, which is basically what premium or discount, on which side of the trade are you, so I'm glad to see that there's more, obviously, work that's being done in terms of market making or even the regulator coming in. But I think, that's something which investors, advisors should be very, very carefully evaluate before sort of buying into that, because, well, over the long term, it may not make that much of a difference, but, you could be in for a rude shock when you were to buy that. Yeah.
Absolutely. And let's also, distinguish that in the precious metals ETF market, there will be two types of people. There would be investors who want to use these ETFs as an investment product to build up their asset allocation, and there would be people who are only in and out for trading. I mean, smart trades on any of these commodities, good luck to them. I mean, you need nerves of steel to trade them these days. But therefore, the volatility aspect, what is causing it? Will it go down now with SEBI's new rules? Vandana, maybe?
Yeah, so obviously there are a couple of rules that SEBI has required of. One is a consultation paper still, the 6% band for the circuit. It's yet to come out. But SEBI is recommending something and asked us for our opinion, which all of us have given, I'm sure. The other is in terms of how ETF NAVs get calculated, right? Now what SEBI has done is that SEBI has tried, before that, SEBI is pursuing the spirit of transparency and standardization for investors, irrespective of whether those investors are advised by advisors or they are doing DIY, right? So at the fundamental crux of the entire, new changes that SEBI wants to propose, you can always see that streak of wanting to standardize, bring the asset class closer to the Indian realities, right? So now coming to the NAV part of it, the ETF NAV part of it, what did SEBI say? SEBI said that, listen, for calculating the value of gold, you will take the quoted price from your domestic exchanges. Frankly, what's been happening till now is not wrong or wasn't flawed in our opinion. Just that there was a layer of a voluntary layering up. So basically, we started off with the LBMA prices. Then each of us would individually layer it up for the Indian landed cost. So which includes your import duties, transportation, logistics, GST, etc., all of it, right? Now SEBI says just take quotes from recognized domestic stock exchanges, MCX, and maybe one or two more which SEBI wants to bring in. And what it does to us as investors is that now you have a standardized way in which all of us sitting across the table here have valued the NAV of our ETFs. Now, it only achieves standardization, Surbhi, because the price at which I buy the ETF is not the NAV. It just helps me benchmark, or helps you and me as an investor benchmark various ETFs that are available in the market today. So that process has got standardized. So whatever changes that you see, obviously you can read through the regulation and see what the regulator is trying to do. But at the crux of it, they really want to get in realism, because they are probably recognizing this as a serious asset class that the Indian investor community is chasing, right? Having said, for a minute, if I assume that fixed income is predominantly institutional investors, I lead institutional business also, so I think it is that way. And I would request everyone to support Vijay's view that fixed income should form a part of all of our personal portfolios too. But if you set that aside, you have about 60 lakh crores of AUM. Now, gold and silver put together is still just about 5%, right? So from that lens, it looks like we are okay. We are not probably overexposed, right? So essentially, I just think that every step that the regulator is bringing about is to recognize that, yes, gold and silver is forming a very important part of Indian investors' portfolios, and therefore they should pay their attention to it, and they should make the process cleaner, more closer to the domestic markets, etc. I think that's my opinion on this.
Great points. Anil, just to go back to the volatility aspect, because I'm asking again for investors who don't understand this too carefully. They may or may not be trading on a daily basis, but they're wondering, my gold ETF is down 7%. What happened? Have I lost money? I mean, the international price is something else. MCX is saying something else. Or silver suddenly trading at a huge premium. So how do we understand the discount and the premium? Will it continue to be as volatile? Will it kind of ease out? What should we expect in the coming months as the product itself grows in popularity?
So Surbhi, I think it's a very interesting thing you mentioned, that people sometimes see the global price of gold and silver. They try to compare with what MCX is showing, and then they try to see what the gold and silver ETF is doing. Some people add to that physical market. Oh, I went to the jeweler shop and what that gold or silver is. Now, structurally, to add to all of this, not responsible platforms like Moneycontrol, but general platforms on Instagram platform, I try to call it on the lighter side, they come up shouting with the big voice that, oh, this ETF is down.
Gold
big
ETF,
time,
silver ETFs crashed 20%.
Yeah, and domestic price is different, and Indian ETFs are dealing from global prices. But the problem with that is that Instagram friends are not understanding that the global price that we look at, or the MCX price we look at, is futures price. It's a derivative contract. It is not a spot price. Whereas the ETFs that we talk about are all based on spot prices. So when your client or your personal investment is into ETFs, please, we have to be clear that is representing spot market in everything, whether it is in equity, commodity, etc. Spot market will always be delinked or different from the movement in the derivative market. It's a very one-on-one basic principle of investing, which Instagram friends try to teach us 101 basic principle of investing, and we sometimes tend to get swayed away and forget. At that point of time, people come and ask people like me and Vandana madam or some other ETF managers के sir और madam आपका ETF तो इतना नीचे हो गया 20% डाउन हो गया but globally market तो खाली 5% डाउन है तो क्या हो रहा है इसमें? Which then we try to explain that is a futures contract, this is a spot market, there is a different element to it, there is a cost of carry, there is a way in which you have to align the different aspects of both, which are same asset but different delivery periods. And sometimes at that point of time, regulator is very alert. So they do realize that. And just as a small thing, it's not that regulator now has said it should be using spot prices. It was always using spot prices, but that spot price was linked with some other global market spot price, which they want to make it simplified, that whether I see a stock price on Moneycontrol app or that time my CNBC is going on and I see it over there, it has to be same.
The spot price has to be the same. But what about the concept of tighter circuits? If that comes about,
I'll tell
then
you.
what happens?
I'll tell. So there is a consultation paper, as Vandana madam very rightly mentioned. Today is the last day for submission. I also have to finish one conference call and submit it as a inputs. Now, once those tighter bands are being proposed and if they come into the picture, what it will do is it will try to align the movement of the gold ETF and silver ETF with the commodity derivatives, either on MCX, NSE, BSE. All three exchanges have commodity derivatives. Right now, the price bands are at 20%, which is linked to any other equity security on the NSE or BSE, which they are now proposing to make it to align with the commodity derivatives. That's the only thing. The issue over there is that our ETF market closes at 3:30 p.m. India time, but silver and gold, they are almost 22-hour market. In India also it goes on till 11:30 p.m. or 11:55 p.m. depending on the season. So between 3:30 and 11:30, there is anyways a moment which has not got captured, and tomorrow morning at 9:15 it has to get reflected. So at some point of time, even if MCX is up only 2%, my ETF is up 8%, does not mean, oh, ETF is doing very well and better than some other market. It's just that it has not participated between 3:30 and 11:30, which it has to reflect in the opening right now. So if those bands come in, which are going to be aligned with the commodity derivative market, it's little challenging because that derivative market has been aligned now from 11:30 p.m. to 9 a.m. only. Whereas our ETF has to get realigned from 3:30 to 11 first and then 11 to 9.
To 9:15.
So it's a little bit tricky. Even it's not that regulator does not foresee that, but it's something which we need to come to some conclusion.
Yeah. No, that's very, very nicely explained. I think very helpful for investors and anyone else who's advising investors on these products as well. We're down to the last 1 minute each. So let me ask this panel, as this new product really comes into its own, and it already is doing that, what would you be expecting on gold and silver ETFs on this part of passives, say over the next year or two? Kaustav?
I think 2026 is going to be, whether we like it or not, interesting in terms of flows, investor sentiment, still being buoyed by past returns. But I think from the fact that, we have a great audience here who can guide investors through that, like even if you're investing today, come with a long-term horizon, come with a graded allocation, come with tempered expectations. Don't think about, silver's given me 100%, 180% return over the last 1 year, or gold's given me 80% plus or whatever in the last 1 year. Don't come with those sort of expectations, because if you do, you're going to be disappointed, right? So I think that's what you need to keep in mind. They do have their place in a portfolio like we spoke about, but in a potentially graded manner.
Okay. Your thoughts as we are winding up, Amit?
So I think this year will be more of a logical year for gold and silver, because I don't think it will be a euphoric year like we have seen last time. And the people who will come this time, I'm assuming it will be more of a disciplined SIP mode. So I think this year will be more of a better asset allocation period for gold and silver.
it will continue to be the year of gold and silver.
Definitely will be part of the portfolio, that's what I feel, because generally we have seen, even if any sector, any asset class, if you see a good rally, people keep on investing for next 3 to 4 quarters. So that's what my expectation, that we'll see the flow in this year as well.
Okay. Vandana?
Yeah, so I don't think I have the courage to make a forward guess, but what I'll say is there is a lot of doubt in the market, and when in doubt, diversify.
I'm so sorry. Can we just send a message outside to stop these announcements, please?
Yeah, so, when in doubt, diversify. So I would only expect investors to know more about asset allocation and basically build the foundation for their homes, and then you can, do up your house the way you want to. But like Amit rightly said, I do think that gold and silver will form a substantial part of customers' portfolios. I only hope and pray that it's the right allocation that they are able to do.
And last word with you, Anil. What would you say to people who've invested in January 26?
My son did.
Sorry?
I said my son
Did you advise him?
No, I didn't. He said, Mama, I have no gold. I think I should buy gold. I said, go ahead. First job, first month's salary.
Wow. Anil?
I think structurally, if somebody has invested in January 2026, I'll just say be patient. If the uncertainty around these 2 big wars and 3 big kings driving the world continues, we will soon see gold to be around $10,000 US. And at that point of time, we will come to give you a guidance that book some gains. Sometimes what happens is that memory is short. Like right now we are speaking that, suddenly gold and silver new of course, but gold ETFs have become large. But many people don't remember that till 2014-15, gold ETF was 80-85% of the total ETF size. Because that time there was hardly any equity or fixed income ETFs. So at that point of time, it is always something which we keep thinking new. At that point of time in 2016-17, when first 2006-7, when first gold ETF was launched, we were talking about numbers which were around $700, $850 gold was considered, like we used to put some Excel spreadsheet around it. Now today, sitting at these levels, when I spoke about $5,000, I'm not just speaking for a number that, time is up, I have to go and have my cup of tea, but I'm just saying with some number which at that point of time at $850 we had put up, like that some number if you put it up, we will come to that $10,000 number, and some global gurus will justify that, and some Instagram friends will persuade many of their investors to continue buying not just Jan 26, but even on March 8, 2026 on Women's Day. Many of the friends will buy for the $10,000 gold. And in our 10th edition of this annual conference, today is the first year, in the 10th anniversary conference, maybe some of us again will be sitting here and thinking of that, yes, in the first edition we had spoken about 10,000
gold was only $5,500.
Only 5,000.
Look at where it is now.
Yes.
Well said. Great conversation. Now, fantastic thoughts and a lot of interesting food for thought as well. Thank you all very much for joining us.
Thank you very much.
Hello. All right, thank you, Surbhi. And of course, gold remains a favorite topic for investors right now. And of course, we've had a thorough conversation upon this. And of course, in the metals, in balancing the risk and resilience within the portfolios. So yes, let's move on towards the final session of the day. We turn to an asset class that often becomes most relevant when markets turn uncertain, and that's your fixed income. So in an environment which has been shaped by interest rate cycles, global volatility, and shifting liquidity conditions, investors are re-evaluating how bonds and other income-oriented products fit into portfolios. How should investors balance yield, credit risk, and stability? And how can distributors guide clients towards income strategies that remain resilient throughout the market cycles? To explore this conversation, please welcome back on stage Mahalakshmi from Moneycontrol. And to share this perspective on navigating fixed income opportunities in uncertain times, please welcome Vishal Goenka, co-founder of India Bonds.
Well, there is not a single session that wouldn't start with the word uncertainty these days. And while in Indian markets, markets essentially means stock markets. I mean, that is the way it has been for many, many years. And you run a completely bond platform. And the obvious thing to, that comes to your mind, if there is uncertainty, go towards certainty. And towards certainty should mean fixed income. And in your perception, how do you think about fixed income today in this environment of uncertainty? And are investors behaving in the way that you would expect them to behave in an environment like this?
Thank you, Mahalakshmi. They say, save the best for last. And I want to thank the audience because we talk about technology doing financialization, but it's really all of you distributors spread all across the country which have made financialization possible. So thank you. Yes, fixed income is a very boring asset class, but a must asset class, right? So when we talk about global allocation, we say 75 equity, 25 fixed income, 60 equity, 40 fixed income. Unfortunately, in India, till 2 years ago, 3 years ago, the common man did not have access to bonds. So my Dadaji told me, beta, fixed deposit mein dal lo, whether it's 5% or 6%. But if you do little more work, which you do in equity, and I heard the precious metals, you can earn 9 to 10%. So people are talking about uncertain times. I'm sleeping very well. I did this search before coming here. Last 4 years, Nifty is up headline 39%. If I bought a bond 10% yield 4 years ago, I'm up 46%. And I slept very well for 4 years. I'm not saying move all your money to fixed income, but as someone was saying, 25% of the allocation of portfolio should be in bonds. The time is now. Interest rate cycle is down, and it's a good time to get in.
No, you're absolutely right. And even the math that, if you found a 9 to 10% opportunity in 3 years back in fixed income versus equities, you would have been better off. But if you look at it post-tax, you may not have been better off. And, that is a very fundamental narrative that is sort of got entrenched in investors' mind. That post-tax, even if you have like a, 9% return on equity, you're very well off compared to debt. How do you quarrel with that, and how do you sell debt in an environment like this?
My question is, how's your post-tax equity return looking for last 18 months? Not much, right? Or probably negative, right? So you're absolutely right. So we've actually, as a online bond platform association, written to the regulators, written white papers to MOFs. Post-tax or interest income is taxed at the slab rate. So look at the difference. A low volatile, stable asset class, you're charging at 30%. A high volatile equity, you're charging at 12.5%. So I think there's a dichotomy, and I completely agree with you. But I do not think in equity we are going to see 22, 23 kind of returns, because that was the big catch-up post-COVID, money coming in, not going to China, Russia, and we've caught up. So if expected return is 8 to 10% equity, and you can get 10% in a bond, or maybe a little lower post-tax, I would choose that still.
And how do you get a 10% on debt? Because traditionally, one of the pain points in debt, and that is also the reason why most Indian investors don't look at debt or bonds positively, is because there is, in credit, there is, the risk perception is also high. That, our ability to navigate down cycles in the past have been quite abysmal. There have been credit accidents in the past, which is also sort of, plays on investor psyche. Not that there have not been equity market scams and equity market crashes, but then when you are earning, 8, 9%, and also because credit is a 1-0 kind of a outcome, it plays on you a lot more. So today's credit environment, how do you look at it? And do we, is 9% a trade that you can really do a portfolio of 9% return without diluting on credit quality significantly?
Very, very good question. So The credit crisis in India happened in 2017-18. We were a $2.5 trillion economy. And everyone asked me this question, sir, DHFL, ILFS, AAA. Now, nobody talks if a stock goes bust or goes down 80%. The problem was about education and awareness. Maybe there was some mis-selling. People said guaranteed money. I think as an economy, we have grown since then. Thanks to digitization, we are reading a lot more. And a lot of regulatory changes happened since then. For example, debenture trustees. When you buy a bond, even if there's a covenant breach in the bond, debenture trustee now emails you. Till 3 years ago, we didn't know that, right? So the credit cycle in India got cleaned up. Public sector banks in 18, NBFCs, mutual funds, they all had accidents. But the last accident you heard about was 5 years ago. And we still remember that because we were told bond means 100% safety. But now with platforms, let's say like India Bonds, for example, you have amazing amount of information. You can read about the company, you can read about the promoter, you can read the rating report, information memorandum. We even have an AI tool by which you can decipher the information memorandum. So yes, for an investor, credit is about risk. Risk-free is government bonds, which are around 7%. But you can build a single A portfolio, a double A and a single A portfolio around 9 to 10%. I would highly discourage people doing triple B minus, which is the lowest rating, or triple B. We don't even show it on our platform because we think institutional investors should go for it. But there's nothing free in this world, right? Except debt, taxes, and government bonds, right? Which are risk-free. So there is risk. Why you're getting 9% is risk equivalent to any other asset class.
This rating also, you know, all the credit accidents we've had in the past. The rating doesn't go from one step to another step to another step. It is usually from whatever it is to D. So, I mean, somewhere the down cycle plays on yes. investor psyche. How do you fight that and how do you guard against that? Is there a way for people to know? Because one of the issues is also the research around debt is not as vibrant in our ecosystem as equities. So that also sort of, in a sense, doesn't give people the confidence that, you know, apne ko pata hai ye.
हाँ, मतलब टेलीविजन पे रोज 10 equity की बात होती है, ऊपर नीचे किसी को track नहीं रहता है. But I'll tell you about this. Listen, rating reports are important. Remember, 2008 financial crisis also happened. There were AAA things that went. Now, I think I will just disagree a little that it does not go binary because, you know, you have a lot more guardrails. Regulators doing an amazing job with rating agencies and debentures, so you see a step down. Of course, fraud, it can go 0 to 1, right? So I do not see much of that happening now, but what you should be aware of. If it says 14%, do not get enticed by that. So, you know, make sure you buy from regulated platforms, you have SEBI protection. Make sure you buy listed bonds because, again, you have SEBI protection. And do a bit of work. And, you know, to safeguard, just don't buy the riskiest. Triple B minus, triple B avoid. You can still get good 11% on a single A asset, but do your research, of course.
Tell me, on your platform, India Bonds, now or anytime in future, is there any plan to sort of have some content or research around debt which sort of gives confidence to investors to sort of look at this asset class? In the way it is in the US, you know, yes. People, there is a very vibrant market for junk bonds also. Yes. In India, it is very, very primitive or yes. non-existent, literally. How do you see this evolving?
No, very good question. We have something called Bond University on India Bonds. We call it Bond Uni. 3 months ago, we did a partnership with Network 18 with CNBC TV and CNBC Awaaz. And every day on television, we have Bond Street segment telling you daily what is happening of fixed income. We've had National Stock Exchange CEOs of asset management companies come and speak on CNBC. So it's about education and awareness to kind of spread that. Yes, I think we will add more research. We have fact sheets on companies to help investors understand better. So the more information and education that we do, and that's what the regulator wants. You spoke about the US market. US corporate bond market is $14 trillion. India is $677 billion only. US market has a 3 to 4% default rate. India defaulted is 0.25%. So I think we are a nascent cycle of growth. People did not have access. We are where equity was 8-9 years ago in terms of awareness. And thanks to technology, we will rapidly financialize, sessions like this, help you understand a little better.
Give us a sense of, what kind of, apart from individual papers, what kind of bundled products or the kind of thing that equity markets offer, like, small case and so on. Are those strategies available, possible on bonds front?
We are the only platform in the country which has something called bond case, where you use technology to solve for it. So if you have an investor, say, I want to invest 5 lakh rupees, you can buy 5 bonds, make one single payment. That technology is not available in the country. So diversification within your financial portfolio, equity, metals, and fixed income is important. And within fixed income, you should diversify also. So those kind of products are available. There are a lot of technology tools. You have an yield calculator, a bond directory, a bond university, a portfolio dashboard where reminders come to you when your cash flows are coming. You can plot your entire bond risk in one place.
So to the investment advisors present here, one of the most preferred categories in fixed income from the audience here, from perspective of the audience here, is the debt fund category, right? Yes. Like, which has also gone through its own up and down cycle because of the tax advantages which went away, and then the category pretty much collapsed. Now, as opposed to the debt fund category, how does this market, which is the open market for debt or bonds, how does it compare? What are the advantages, disadvantages?
Very good question. See, equity mutual funds and direct equity coexist, right? So debt mutual funds and direct bond investment coexist. Debt mutual fund had indexation, which went away 3 years ago. But if you see the history of performance or returns of debt mutual funds, it's roughly around 6 to 6.5%. And if you see the overnight liquid funds give you 5.25%. So it's really the trade-off. Can you create your own bond portfolio like an equity portfolio and earn 9 to 10%? That 3% compounding in 10 years, we all know here, makes a difference of 70 to 80%, right? So the benefit of debt mutual funds is instant liquidity, but you are making 3 to 4% lower than that. If you actually go for a 10% bond liquidity, we are building. You can exit in a day or two, or immediately. Government bonds, etc., you can sell immediately. But it is better than what existed in the country, right? People have NPS fixed income products, RBI floater bonds. They have 5, 7, 15-year lock-ins. SGB, which is done so well, the government just took away that if it is not held to maturity, you don't get tax benefit, right? If you compare to that, you have a lot more flexibility in direct bond investment. The choice is yours. It's about return, risk, and learning a little more.
What is one last question, since we have only 2 minutes? What is your own take on the interest rate trajectory? Because that is the single most important determinant of finally what the returns at the end of the period is going to be. Where do you see it in the cycle, given that we have all these uncertainties, US bond yields have already strengthening and so on?
So I think India interest rates are going to stay low for very long. If I study the history of economies globally, whenever an economy from a poor to developed goes, take Korea for example, interest rates just tend to come down because the country is much better, right? So I think we're in a very good interest rate cycle. The problem in India is a steep yield curve. I promised I will avoid jargon, which means 10-year is much higher than when the overnight rates is. But that cannot exist forever. I think once the new financial year comes, it's going to go down. The only risk or shock is if oil goes above 100 and sustains, then globally that creates more inflation, right? So US is a different game, with Trump and the new Fed chair. I think they naturally want to cut interest rates. So I do not see rates going much higher or high at all in the next 2 to 3 years. So very, very benign. And we had RBI governor himself say, we are here low for long. So in times of uncertainty, in a low interest rate, base rate, you're hearing the top guys in the country say that, just take some money, park in fixed income, and sleep a little better.
So no no capital losses from here on debt.
I don't think that. I don't see that, right?
Next 1 year, I mean, if we were to look at a slightly shorter term period, because definitely 1 year is, a lot of people will be contemplating, should we get out of equities and be in debt at least for a year till things settle down. Can one be sort of assured that capital losses will be minimal?
I think 98% or 99% surety interest rates are not going to go up in India for another 2 years. Okay, and capital loss happens if you're on a government bond product. Because in India, the AAA segment moves with government bond, but if you're buying a single A, double A credit at 9-10%, it does not move that much with the actual interest rates, right? So, given what I heard, all the panelists, people are unsure, gold, silver, equity, and you know, again, on a platform this year, we saw 5 to 10x growth because people realize they've made money in equity. They have made money in gold, but you want to preserve that capital. In your pocket, you have 100 rupees, you'll bet in equity. But now you have 1 lakh rupees in your pocket. You're not going to bet that in equity. We are a richer country. So our asset allocation has to be according to paying attention to some capital preservation and also some for growth.
True that. As we get richer, let's protect our money a lot more. Thank you so much for this really engaging discussion. Thank you so much.
Thank you, Mahalakshmi. Thank you, audience.
Thank you, Mr. Vishal, for those practical insights. And I'm sure investors who are with us have a clear picture of what's in the box when it comes to choosing fixed income products. Thanks, ML, and for this lovely conversation as well. But yes, as we conclude the day one of Moneycontrol's FiDEX 2026, today's conversation has made one thing abundantly clear, that distribution in India is no longer transactional. It is strategic, technology-enabled, compliance-driven, and deeply intertwined with investor confidence. So thank you for being a part of the first day. We look forward to welcoming you back tomorrow as we explore how to build the advisory businesses of the future. Do have a wonderful evening.